Welcome to the Baker Institute. We are delighted to have you all in person today. This is the 6th Energy Conference, sponsored, partnered with Baker Botts and the Institute, and the first one with a full attendance and a full program in person since 2019. So with this event, we really launch a meaningful series of in-person, reset and restored meetings, speaker programs here at the Institute. We look forward to welcoming you to the other events on the schedule, both energy-focused and on the other topics that we believe are of interest to all of you in this room. I want to give two special recognitions this morning. The first is to John Martin, Managing Partner of Baker Botts. They have been stalwart partners, associates, friends of the Institute, of Rice University, and of course critical to this series of conferences. We could not do it without them. So, John, many thanks. The other is Ken Medlock, the director of the Energy Center here. The Energy Center is a star and recognized as such internationally, but stars need to keep glowing in order to continue to be recognized, and meetings of this kind are part of the way in which we stay in touch with you, you with us, and we continue to be a dynamic presence in assessing, speaking to, stimulating debate about critical energy issues. Now, my final comment will be self-evident, but I'll say it anyway because I can, which is I cannot think of a moment when the topics under discussion today, energy markets, the disruption now and likely in the future created by Ukraine, technology issues, whither the transition, all of these are vital for the sector, vital for markets, not just here in the United States, but internationally. The work of the Energy Studies Center here is focused on these and many other issues. And as we discuss through the day these questions, we welcome your engagement, your participation, your questions. And with that, another thank you to all of you. John, podium's yours.
Thank you, Ambassador Sutterfield, and good morning. It's really great to have everybody back in the House today. What a heartening feeling this is. And welcome to the 6th Annual Energy Summit. Appropriately, the theme of this year's summit is Risk and Opportunities. Energy transitions meet energy security. And Baker Botts is proud to be the premier law firm partner of the Baker Institute Center for Energy Studies, and we appreciate the opportunity to jointly develop and host this innovative conference. As many of you know, members of Secretary Baker's family were among the founders of our law firm nearly 2 centuries ago. This is our 182nd anniversary this year. And our commitment to the Baker Institute is a reflection not only of our shared history with Secretary Baker and Rice University, which happens to be the firm's oldest client, but it's a reflection also of our respect for the world-class research and thought leadership the Baker Institute provides on energy and other public policy issues. This year's conference will address what is arguably the largest issue facing energy markets in the world today. It's the complexity of balancing energy security needs with energy transition goals. An issue that has assumed even greater urgency with the war in Ukraine. And I'd like to pause and give a shout out to 3 of my partners at Baker Botts who have served as this year's program co-chairs. Julie Mayo, partner in the Global Projects Department. Is Julie here? Megan McKelvey, I saw Megan earlier. Megan's right here. An energy litigation partner, and our corporate partner, Natasha Khan. Natasha, if you're here, raise your hand. Thank you for your hard work on pulling this program together. Let's give them all a round of applause. We continue to find ourselves in a period of unprecedented change in the global energy sector, which is why this event is so important. And as the leading international energy law firm, Baker Botts itself finds itself playing a key role in these momentous changes. And we are actively working arm in arm with our clients, many of whom are in attendance, to manage risk and capitalize on opportunities in this rapidly changing environment. On a macro level, this conference will address how we are helping our energy clients respond to recent geopolitical and market events and helping them evaluate how developments will impact the momentum of a meaningful energy transition. You know, at Baker Botts, we like to say that we embrace an all-in approach to energy, where we are serving clients both in the oil and gas industry and in renewable and conventional power sectors. And this includes industry-leading expertise and business acumen in wind and solar power, battery storage, power generation and distribution, lower carbon fuels like renewable natural gas, biofuels, green and blue hydrogen that support energy transitions, carbon offsets and trading, LNG, including lower carbon and carbon neutral LNG, carbon capture, utilization and storage, and energy technology. At Baker Botts, we are committed to providing our clients with a multidisciplinary, full-service approach to serving their needs. And others continue to recognize Baker Botts as the go-to firm in the energy industry. In Chambers and Legal 500, we continue to improve our rankings even further across the entire energy spectrum, advancing our leadership in a broad range of subsectors that include power and renewables, LNG, oil and gas, and energy litigation. And for the third straight year, Law 360 has named us as the Energy Practice Group of the Year. A few of our recent transactional highlights include representing Shell USA in its $2 billion acquisition of Shell Midstream Partners, Crestwood in its $1.8 billion acquisition of Oasis Midstream Partners, BKV in its $750 million acquisition of XTO's assets in the Barnett Shale, and in what is a landmark transaction in the renewable natural gas space, we represented CIM Group in its acquisition of the development platform from an affiliate of Mass Energy, a leading developer, owner, and operator of landfill gas RNG in the US and Canada. Globally, it was recently announced that we've been engaged by the Tanzania Petroleum Development Corporation to advise on a $30 billion LNG project in Tanzania. And here at home, the Texas Law Book recently ranked us as the #1 legal advisor by both deal count and deal volume for capital markets transactions in Texas for the first half of this year. And these capital markets deals were conducted on behalf of Sonova, Centerpoint, Valero, and a number of other prominent clients. We are proud of our long and successful history in the energy sector and our collaboration with the Baker Institute on this program. Well, we have an incredible lineup of speakers and panelists for this summit. Today, Joe DeCarolis, Administrator of the U.S. Energy Information Administration, will provide the keynote address on the global energy outlook. We will then have a discussion on the micro risks for the energy landscape with a keynote from Rob Kaplan, former President and CEO of the Federal Reserve Bank of Dallas, and my partner Megan McKelvey will moderate that panel discussion. Then my partner Travis Wolford will moderate a panel discussion titled Financing the Future of Energy. How is the landscape evolving? The list of industry-leading thought leaders speaking throughout this two-day event is quite impressive. And we are delighted to be co-hosting this event with the Baker Institute, and we look forward to a continued collaboration with them and with our clients for many years to come. Thank you for your time. Thank you for your attendance. Enjoy the conference. And now I'd like to turn this over to Ken Medlock.
Well, I got to say, I'll echo the sentiments of both Ambassador Satterfield and John Martin. It's great to see a room full of individuals to have this discussion. First and foremost, I definitely encourage you to participate in the conversation. The way to do that will actually be to pass cards that you'll be able to write questions on over to the aisle. And you can do that at any point during the panel or during the keynote, and we'll make sure that we filter through those and get those questions asked. I will be moderating the first two keynotes before handing it over to Megan, where we'll get into the panel discussions. The structure of the day is, actually the structure of the next 2 days is kind of done in a way to build on the previous remarks. So we'll start with Joe DeCarolis. He's going to give an energy outlook, and he's also going to discuss why they're hard, in a nutshell. Everybody knows that a forecast is only as good as the minute it's actually done, because somebody's going to throw a stone in the water and create all kinds of waves, and it's going to alter the landscape dramatically. And so we've seen that this year. In fact, EIA's most recent annual outlook was released, I believe, was in March, right? Yeah. And the work that goes into these things is basically the culmination of a full year of a long exercise. And as you might imagine, coming out of COVID, and then all of a sudden Russia invades Ukraine, talk about stones being thrown in the water. So there's a lot to sort of digest in that regard, with regard to the outlook. But the key point here is uncertainty is a critical component of any discussion on energy, both current and in the future. So I think, given Joe's background, which I'll introduce him in just a minute, he's a perfect person to actually talk about that. One significant driver of uncertainty is the macro landscape, which is exactly why we'll follow up Joe's discussion with a keynote by Rob Kaplan. And he'll sort of get into what the macro landscape currently looks like, how it's been evolving, sort of how it's gotten to this point, and maybe give us some insights or his thoughts on where he thinks things might be going. That will set the stage for the panel discussion, which will be really interesting because we'll have a diversity of individuals participating in that discussion from different points in the energy value chain, very different perspectives in terms of core business activities. And they'll give their insights and thoughts on how the macro landscape is evolving and how it's actually impacting what they do, which is, I think, going to be really eye-opening to a lot of folks. I'm looking forward to that discussion. Of course, when we talk about transitions, we can recognize all the uncertainties, but eventually we have to recognize that it's also very capital intensive because we're talking about infrastructure development. Anytime we talk about massive infrastructure development, the word scale automatically comes into mind, and I'll just say most people don't fully appreciate the scale of the energy industry globally. And I think that is one of the things that everybody has to come to a recognition of, because if we're going to meaningfully talk about energy transitions and pace of transitions, we have to first recognize the scale of the existing infrastructure. So understanding that and understanding how you finance the turnover of that infrastructure or the retrofit of that infrastructure, the evolution of that infrastructure is going to be critical. And so the last panel of the day will dive into those issues. And then we'll launch tomorrow with a keynote by Bobby Tudor that really highlights that everything starts locally. Many of you probably know Bobby. He's currently serving. I think he told me he's spending about 40% of his time, roughly, on the Houston Energy Transition Initiative with the Greater Houston Partnership, which is a Herculean task, just to be blunt, to coordinate all of the different business interests in the region to think about how we approach the portfolio of transitioning the energy system in Houston. Historically, Houston is the oil and gas capital of the world. It's kind of what its moniker was. Turning it into the energy transitions capital of the world is a key goal of a lot of the work that's going on in the city right now. And it's interesting because Houston has a touch point at a major sort of private sector level with every aspect of energy, be it renewables, be it oil, be it gas. It doesn't matter. There is a touch point in the city. So I'm really interested to hear what Bobby's going to say and how he's going to sort of expand on these issues to highlight what's actually happening regionally and how that can actually be a landmark, if you will, for the world. If it doesn't happen here, it's not going to happen anywhere, to be blunt. But then from there, we're going to, and I'll be moderating a panel just after Bobby that will dive into what the portfolio looks like, right? And how different companies at different points in the value chain are approaching the evolution of that portfolio, the role of technology, the role of existing infrastructure. All of these things are critical components when we talk about energy transitions and delivering energy reliably and securely. And that, of course, sets the stage for the very last panel of the day prior to what will be really a treat, to be honest with you. There'll be a fireside chat between Ambassador Satterfield and Secretary Baker, where they'll get into all sorts of policy-related issues. But that last panel is going to be focused on the issue of energy security. And of course, there will be a lot of discussion about Russia and Russia's invasion of Ukraine and what that means, right? Not only in the current moment, but what seeds it's planting as we go forward and think about the future of energy. All of this comes together in a way that you can effectively kind of pull a thread through the entire 2 half days and hopefully walk away with something that is insightful that you had never thought about before and leads you to ask questions, because we don't actually learn anything if we're not asking questions. So hopefully all of you will step away from the 2 days deliberations with some new insights and new questions, quite frankly. I think that's the way we actually better ourselves. So before I hand it over to Joe, I just want to make a couple of logistical announcements. First of all, there are no planned fire drills. So if you hear a fire alarm, first and foremost, we've got to exit. There are actually 2 different directions we can leave: out the way you came or down the hallways this way. There's 2 muster points. One is actually by the fountain out front. The other 2, if we exit the building in the back here, are out on the street. So just want to let everybody know that. The other thing is the restrooms, for those of you who aren't familiar, are on either side of me down the halls here. So the men's is on this side and the ladies is on this side. It's going to be a full half day. You will see during the breaks, and I have to mention this as well, today we will be showing a film that is produced by a group called Rational Middle. It's actually a really interesting perspective. They've done a really good job. For those of you who aren't familiar with the production group, they do a really good job of presenting issues that can be contentious and actually showing both sides of a discussion. So that you can actually kind of walk away with a balanced view of what's going on. They don't pretend to give us any solutions. It really is just talking about issues. And these are shorts. Today you'll see one during the break, so I encourage you to take a peek. We've been heavily involved in those over the years. It's a lot of fun. Sometimes it's odd to hear your own voice talking back to you on a screen, but it is what it is. But it's a lot of fun, and I encourage you guys to look at that, definitely. So with that, what I want to do is sort of step off the stage and hand it over to Joe. Dr. Joseph DeCarolis, he's the administrator at EIA. He was confirmed administrator of the U.S. EIA earlier this year, March 31st, 2022. I'm sure he has a lot of interesting stories about confirmation, but I don't know that he's going to talk about those today. Previously, he was a professor in the Department of Civil Construction and Environmental Engineering at NC State. He also worked previously as an environmental scientist at the US EPA. A lot of his work is on energy systems modeling and the intersection of predicting futures under uncertainty, juxtaposed against issues that kind of encapsulate transitions, economics, policy, et cetera. So again, I can't think of a better person to get us kicked off today with an energy outlook. Joe, stage yours.
Situated here. All right, let's see if I can get this to work. Great. All right, well, it's an absolute honor to be here with you at the Baker Institute for your annual Energy Summit. It's also an honor for me to serve as the EIA administrator. I've been on the job just under 6 months. And I really, truly believe in the mission of EIA to provide unbiased data and analysis, given what's going on in energy markets around the world. Our data analysis is really crucial to informing decisions. So here's the outline for the talk. I took a little bit of liberty with, with the scope of the talk. So I want to start by talking about key trends, both globally and domestically. And these are some of the things I want to talk about. I want to talk about natural gas and LNG exports and some of the work we're planning. talk a little bit about what we see happening in the electric sector and the transition that's underway. I have a slide on the Inflation Reduction Act, which could have a significant impact on our energy system. Talk a little bit about petroleum supply and demand. And so that part of the talk constitutes this discussion of what we see happening. Then I want to shift gears and talk a little bit about my priorities as EIA administrator. And then I'm going to end by talking about some of our plans for the Annual Energy Outlook 2023. And as Ken mentioned, as a long-term modeler, the AEO has a special place in my heart, and I have lots of ideas about how to build on what's there now. And the other thing I'll say is I just want to acknowledge all my colleagues at EIA. You know, in putting together this slide deck, I had a lot of help in thinking through what our experts saw as some of the key issues. And I want to begin by talking about natural gas. So obviously, we're all concerned about the impacts from the Russian invasion of Ukraine, in particular as we're coming on winter, what's going to happen during the European heating season. In the US, that's meant a very tight market, and there's low elasticity of substitution in the electric sector. I'll talk a little bit more about what I mean there. And this is an area where at EIA, we're trying to be really proactive in our analysis. So we have a few things that are forthcoming. One is that we're planning to provide regular natural gas updates within Department of Energy. I'll show you a screenshot. We also have a natural gas storage dashboard that provides a lot of useful information, so expect to see a lot from us on our website about gas on a regular basis. We're also planning what we're calling a tabletop exercise. So every month we release the short-term energy outlook, and following the October release, we're gonna have a separate analysis where we look in a little bit more carefully at different scenarios around supply and demand and how that might affect the U.S. market for natural gas. And then finally, we'll be releasing the annual energy outlook in the spring, but following that, we're going to release a separate issues and focus report around LNG exports. So we're going to run our national energy modeling system, which is the model we use to produce the AEO, but we're going to vary the amount of LNG exports over the next few decades and then see what the effect is on the domestic market for natural gas and how that sort of ripples through the energy system. So those are just a few of the things we have on tap at EIA. Okay, we're EIA, so I want to get into some data and walk you through some of the things we see with regard to natural gas. So the figure on the left shows international natural gas prices over the last couple of years. You can see this is in dollars per million BTU. We've got the Henry Hub price down in Louisiana. We've got the Japan-Korea marker, which represents gas prices in Northeast Asia. The MBP is the virtual trading hub for gas entering the UK market. TTF is Tidal Transfer Facility, which is a trading hub in the Netherlands. And then finally, just as a point of reference, we have the Brent crude price. And there's a lot of interesting stories that you can tease out of this graph. So one is, let's see if this, oh, there we go. The pandemic, right? We all went into lockdown in early 2020. It's a little bit harder to see the decline in natural gas prices, but you can see it pretty clearly in the price of Brent. Demand cratered, prices went down, a lot of supply was curtailed. And then I think the story post-COVID has been one of very high volatility, and I'll just point out a couple things. One is we have the Russian invasion of Ukraine early this year that led to a spike in prices in Europe and in Asia. And then something else very interesting happened. On June 8th, we have an LNG export terminal in Freeport, and it caught fire and it shut down, and that led to this decline in domestic gas prices. The Freeport facility represents 20% of our LNG exports, Because of the accident, it shut down. That meant more natural gas would be available domestically, so the Henry Hub prices went down. But you can see this very clear increase in international prices, and that kind of coupling between what happens in the US and what's happening internationally is relatively new. We would not have seen this 10 years ago, not even 5 years ago. So this is something new. The market is moving towards greater integration. The figure on the right shows LNG export capacity. And the thing that amazes me about this is that the export of LNG from the lower 48 began in 2016, and the U.S. is now the largest exporter of LNG in the world. It's really remarkable. On top of that, you can see these are just the three facilities that are closest to reaching operation. They're currently under construction. Golden Pass, I believe, started construction in 2019. The Corpus Christi Stage 3 and Plaquemines are more recently under construction. And there's several more of these facilities in the queue, so it's something to keep an eye on. And we do at EIA produce a quarterly database of LNG facilities, so it's something that you can track through our website. This is our natural gas dashboard. So what I'm showing you on the left-hand side is just a screenshot of the page. And it provides a lot of useful information. So it shows, for example, in the top left here, this is showing you working gas storage across different regions in the U.S. It gives you temperature information. If you scroll down, there's lots and lots more. The figure on the right, this is data that we're tracking internally right now. At some point, we might make it available at the dashboard, but I just want to give a sense into the things that we're looking at. So we have data on each LNG export terminal in the U.S., and we know the destination associated with the LNG for each of those facilities. So in this particular case, this is the sum of all the terminals, and you can see where it's headed, and this is an interactive thing. So if you mouse over the different bars, you can see by month where those exports are headed. So again, at EIA, this is something that we're watching very, very carefully. Okay, so that's kind of what's happening internationally with natural gas. And I want to talk a little bit about what some of the effects are domestically with a focus on the electric sector. So the figure on the left shows working gas in underground storage. The gray band represents the 5-year range. The dark gray line there represents the 5-year average, and then the blue line represents where we are in terms of storage this year. It's a little bit out of date, but we're just inside the 5-year range, but well below the 5-year average, which is an indication of a very tight market. Okay. The other thing, so I'll talk a little bit about the figure on the right-hand side. This one's a little bit complicated, so I want to walk you through it carefully. So if you look at the horizontal axis here, we've got billion cubic feet of gas, and basically what that represents is the amount of basically the weekly change in natural gas storage relative to the 5-year average. Okay. And then on the vertical axis, we have the price of natural gas at Henry Hub. Each point here is a week, and the points are colored by what year they are. So the first thing that jumps out, right, is 2022. So I'm going to set that aside for just 1 second and focus on the rest of the years. So again, back to the horizontal axis here. So for a given week, if we're seeing a deficit relative to the 5-year average, again, that's an indication of a tight market, right? And that's going to produce higher prices. On the other side, if in a given week we see a surplus, that's an indication of a looser market and lower prices. And so we have historically this pretty nice relationship with a negative slope. And then we have 2022, where storage levels haven't changed all that much, the relative deficit, but the prices are all over the place from $4 per million BTU to over $9 per million BTU. So, and by the way, the orange point up at the top here is just the most recent week of data we have. So what is going on? Clearly, we're seeing different behavior here. And we think that there are a few things going on. This is a really complicated story. But one is that there are very high international natural gas prices, right? So our exports are going to be robust regardless of what the Henry Hub price is. Production and rig deployments are up, but probably not up as much as they could be, given where prices are. And our understanding is that there are some supply chain issues. I mean, it's, again, a complicated story, but one factor is supply chain issues. There are labor shortages, challenges getting material like sand or steel. So some of the same supply chain sort of issues we see in other industries also affect natural gas. And then, as I'll describe, the demand for natural gas has become more inelastic, particularly in the electric sector. So moving on to the electric sector, on the left-hand side here, we have installed capacity of coal-fired power as well as combined cycle natural gas. And we see this decline in installed coal capacity and this rise in combined cycle gas capacity. So we're seeing the substitution of coal with gas over the last decade or so. On the right-hand side, it's telling a similar story, but this is looking at monthly coal production, which is kind of that brownish color, and natural gas withdrawals, which is the blue line. Again, you see coal declining, you see natural gas withdrawals increasing. Same story with the coal stocks that are being held by electric utilities. They are on the decline, okay? What's going on here? Well, one is just structural changes in the coal industry. We've had sustained low natural gas prices for a fairly significant period of time, which has made coal less cost effective relative to natural gas. And so that's resulted in a number of coal plant retirements. There have been constraints on the rail system. We've increased exports of coal. And so all of that means that there's been less production of electricity from coal. And the consequence of that is on the right-hand plot here. And so what we're looking at is on the horizontal axis, we have the near-month natural gas futures price, again, in dollars per million BTU. And then we have on the vertical axis the share of natural gas as part of daily thermal generation, okay? So each point is a day. Similar to the previous plot, the points are colored by year. And if you focus first on 2018 to 2020, this is the behavior that we would expect normally, right? That, okay, gas prices go up, and the share of natural gas goes down, and it's largely compensated for by coal, that you have this trade-off between natural gas and coal to fill this thermal gap. What we find in 2021 and 2022 is we move from having a negative slope on this graph to a positive slope. So when the prices are high, the demand is actually higher. So we have this really inelastic demand for natural gas in the electric sector, due in part to this retirement of coal. The other big story, of course, in the electric sector is the expansion of renewables. So this figure is taken from our short-term energy outlook from this month. And on the left side, this is electricity generation in billion kilowatt hours. The middle shows the share from different sources, and the right shows is a breakdown of where the renewables, what constitutes the growth in renewables. And one thing I want to mention here is with our short-term energy outlook, this is not a capacity expansion model where we're trying to model the growth in capacity. This is survey results. We ask utilities on our 860M survey every month, how much new capacity of each type do you plan to build? So that we know. What the modeling is doing is figuring out dispatch. We have all this capacity, how do you dispatch it to meet demand? So I view these numbers as pretty robust, and you can see that, not surprisingly, we expect renewables to grow significantly through the end of next year, and you can see that much of that growth is solar and wind. Layer on top of that the Inflation Reduction Act, which has some very significant incentives for renewables. So it includes an extension of the production tax credit for wind, the investment tax credit for solar. There's a prevailing wage bonus credit. So for projects that can meet requirements for prevailing wages and apprenticeships, they get a credit that's equal to 5 times the base credit. And then finally, there is a storage investment tax credit equal to 30% for standalone storage, which, so all of these things are likely to have a significant impact on the electric sector. We're still modeling it to figure out what the longer term impacts are, but these are notable incentives. Now, our modelers are carefully working through all of the provisions in the Inflation Reduction Act. It will become part of our reference case in the AEO 2023 because it's now law. So I don't have any results to present. You'll have to wait for the spring for that. But I did want to just show this result. We did recently release Issues in Focus, where we use, again, our National Energy Modeling System to look at a set of different scenarios that we don't cover in the main AEO. This one was focused on applying different carbon fees. So you can see the reference case, and then we have 3 different carbon fee levels, a $15, $25, and $35 carbon fee. Those are set in 2023, and then they grow by 5% annually until you get to 2050. And what I'm showing here is the deployment of technology in the electric sector. And I think what's interesting about this is that when you look at all the carbon fee cases, we have close to a terawatt of wind and solar combined from these cases. I mean, those are pretty large numbers. So we'll see what happens when we implement the Inflation Reduction Act. But this is, of course, we don't have a carbon fee. We have the Inflation Reduction Act. But I think it's indicative of where we expect renewables in the electric sector to go over the next few decades. And again, that report is published on our website. Okay. In terms of trends, I wanted to close out this portion of the talk by talking a little bit about petroleum and refined products. This figure also comes from our latest short-term energy outlook, and I think it nicely tells the story of what's been happening over the last few years. Of course, wrong button. Of course, the most notable thing is the drop in demand as we went into our COVID lockdowns, right? So there was a pretty good balance between supply and demand, and then all of a sudden demand dropped precipitously because of COVID. And you can see that demand fell much faster than supply. The difference between supply or production and consumption is shown here on the bottom graph, which is our implied stock build. So if production outstrips consumption, we're building stocks. If the opposite happens, if consumption outstrips production, then we're drawing on our stocks. So you can see, COVID, this precipitous drop, demand dropped faster than supply. As we began to get back to normal and come out of COVID, economic activity ramped up, demand outstripped supply, and that led to these withdrawals. You can see beyond where we are today. This is the forecast portion of our STIO. Under nominal conditions, we assume a relatively balanced market, but as you know, lots and lots of things can happen, right? Geopolitical events, are we headed for a recession? Lots of things can happen, but under sort of nominal conditions, we expect a balanced market through the end of next year. I think another story that's emerged recently is the amount of refined petroleum products that we are exporting. So the figure on the left is similar to some of the previous ones I've shown. The gray band represents the 5-year range. The green line is the 5-year average. And then you can see the lines for 2022 and 2023. The latter half of 2022 as well as 2023 is obviously our forecast drawn from the STIO, and it's well above the 5-year range. In fact, the first half of 2022, this is the most refined product we've ever exported going back to 1973. Okay, so we really are exporting a lot of product right now. The figure on the right shows the total amount of petroleum products that we're exporting, as well as the composition of those exports, which are fairly well balanced between different refined products. Okay. Another story has been the decline in refining capacity over the past couple of years. So again, as we went into COVID and demand went down precipitously, we had the loss of some refining capacity. You can see it went from 19 to about 18 million barrels per day. Some of that was refineries that simply went offline and were retired. There was some amount of capacity that was converted to biorefineries, but that's also contributing to the tight market that we're seeing today with regard to petroleum. A figure over here on the right is just showing the stocks of distillate on a regional basis, and you can see, for example, on the East Coast, they are quite low compared to where they were a couple years ago. If we look at this nationally, again, you see the 5-year range in the gray band and what we expect for the latter half of 2022 and 2023 for distillate inventory, and you can see, again, we're well below the 5-year range. And again, this is an indication of a very tight market. Okay, so that's my very quick spin around trends that we're seeing both globally and domestically. And I want to shift gears and talk a little bit about my priorities for EIA, as well as some preliminary plans for the annual energy outlook. So these are my priorities. The first is I want to strive to make EIA's information more transparent and accessible. On the modeling front, that means a move towards making them open source. Okay, I'll talk a little bit more about what I have in mind with regard to NEMS. And then on the data side, we do make all of our data publicly accessible, but I think there's things we can do to make that data more accessible, so we can build tools and dashboards that allow people to really visualize, manipulate, and download the data in a customized way. And we're developing new capabilities to do that. Second is I want to be able to expand our energy modeling capabilities in order to examine a wider range of futures. As Ken alluded to in his opening remarks, I mean, the last few years we've had COVID, the Russian invasion of Ukraine, a number of other issues. So we really need to think expansively about our energy futures. I also think that there's a real opportunity to provide new insight into energy trends at the community scale. One of the things we do at EIA is we conduct something called the Residential Energy Consumption Survey. And for the first time, we went from a model where we sample 4 states to all 50 states. So we now have data from all 50 states, and there may be ways to combine that most recent REX data with demographic data to say something about community scale impacts. I mean, again, we're experiencing volatile energy markets. The energy system is in transition. It would be really useful to be able to know what's happening at the community scale. Fourth bullet is to modernize IT's enterprise. We're trying to move our data, all of our data and analysis to the cloud. And that's going to open up some really exciting possibilities. One of the things we're doing in parallel that I just want to mention is we're building kind of a universal data dictionary. The way things have worked historically at EIA is data comes in sort of separate streams, gets processed, and it's used to produce a product. We want to take all of our data and put it into a single massive relational database that can be then queried to create these tools and dashboards. And again, I think that there's some really exciting possibilities for things we can do there. And then finally, we're in a hybrid workplace. Since COVID, we have folks who work 100% remotely. We have folks who come into the Forrestal building a few days a week. So I just want to ensure that we have, in our hybrid workplace, that we're promoting diversity, equity, and inclusivity. And shameless plug, we are hiring. So if you have students, colleagues, if you're interested in EIA, come talk to me afterwards. Okay. Last topic is the annual energy outlook. As I mentioned, I've been an energy systems modeler for quite some time, so this is a topic that's near and dear to my heart. The annual energy outlook has been produced by EIA since 1979. It's widely cited. It's one of our highest visibility products. And the reference case in particular, the assumptions and results are often used as a benchmark to see where things are. It's used as a reference in other modeling exercises. The way the analysis is currently structured is we have this reference case, and then we have a series of core side cases. So in the last AEO this year, we had the following 8 cases. So you've got high and low oil prices, high and low oil and gas supply, high and low economic growth, and then the high and low renewables costs. Okay. Now, I'll just preface some of what I'm going to talk about by my experience as a modeler. And there's 2 high-level insights I've come to over the years. One is, even the most sophisticated energy model is a gross simplification of reality. It just simply is. Second, because of the complexity of the system that we're trying to model, there are always going to be irreducible uncertainties. We can spend a lot of time and effort trying to reduce the uncertainty bars on some of our model inputs, but there's always going to be uncertainty. There are just irreducible uncertainties, surprises, things that we just can't anticipate. So in my mind, those 2 things together call for humility in modeling, not just at EIA, but everywhere. We need to think carefully about what are the robust insights that we can draw based on the fact that we have uncertainty moving forward. One of the challenges I see is around the way that we characterize our reference case. This is just an example of some social media chatter. When the EIA when we released our annual energy outlook, there was a Today in Energy article, and then we made this statement that EIA projects renewable generation will supply 44% of electricity by 2050, and people are kind of calling us on the carpet and saying, "Hey, I thought it's not a forecast or a projection." And I think in general, we have to be careful about how we're presenting the reference case. And this is deeper than just what we call it: prediction, projection, scenario. It's how we contextualize the reference case, talk about it in relation to the other work that the other side cases that we're presenting. So this is what we say about the reference case in bold on the right-hand side, that the reference case serves as a baseline for comparison between side cases that explain alternative trends. Okay, that's fair enough. But then in many ways, we treat the reference case as our best guess. So even the language, we have reference case and then we have side cases. It sounds like they're kind of off to the side, maybe less important or less probable. I went through the AEO narrative. 70% of the figures exclusively focus on the reference case. And then finally, we also write a retrospective report where we compare our model projections to what actually happened. And there we also exclusively focus on the reference case. So there's just a lot of focus placed on the reference case. And given all the uncertainty, there's only one thing I know for certain, which is that what actually happens will not be the reference case, right? Because we're trying to take a slice through this high multidimensional space, and we know that reality is going to deviate from a single line projection, right? So these are some of my thoughts, and this is how I've started to direct the modelers. First is we want to increase the range of results to better capture real world possibilities. So when we're looking at our core cases, our core side cases, we want to reevaluate some of those assumptions, maybe make them a little bit, choose them in a way that we get a wider range of outputs from the side cases themselves. The second thing is all of the analysis in the annual energy outlook is one at a time perturbations. You have the reference case, okay, high oil price, right, compared to the reference case. Low oil price compared to the reference case. So I've directed our modelers to start looking at combination cases. What would happen if you had high macroeconomic growth, high oil price and low renewables costs? What happens if you die all the knobs in one direction or the other? Again, we're trying to cover more of the decision space with the scenarios that we're running. And then part of this is also in our visual communication of the results, and I'll show you an example in a moment. The reference case is still very important, so we want to call attention to it, but we want to emphasize that there's a range of results around that reference case. And the final thing is, the AEO itself is, you can think of it as a set of products. There's the narrative, we have a chart library that has like lots and lots of graphs, and then there's a table browser where you can go in and drill through the results and produce tabular results. But what I've emphasized is that the narrative, in my mind, is one of the most important things because it allows us to contextualize the results. We need to be able to present the results. We need to be able to lead the reader and explain what we think are the robust insights out of the analysis that we've performed. So I think that the narrative is very important. This is just an example. So actually the box on the top right, that's an example that I really like from the last AEO, where we show the reference case and then we show the range from all the side cases. And so this is just an example where I sort of built on that. And you can see this is showing CO2 emissions across all the cases that we ran last year. And the reference case is still denoted by this black line. The side cases are a blue line. The most extreme cases that form the boundary, the uncertainty cone for emissions, are dotted lines. Doesn't mean that those are the actual bounds. Those are just the bounds based on the limited number of scenarios we ran. And then also the area is shaded, right? The idea here is there's not a discrete number of scenarios in the real world. It's a continuous decision space, right? And so trying to find ways to visually communicate that to the audience. This is some preliminary thinking that I'm showing you. If you have ideas, catch me afterwards and let me know what you think. Okay, modeling, I just have a couple of slides here. So in terms of where the modeling goes moving forward, in the short term, I mentioned that one of my priorities is transparency in modeling. So we're planning to make the main components of NEMS publicly accessible via GitHub with a well-established open source license so that we're very clear about waiving patent and copyrights on the code and data that we produce. We also are coming up with a governance plan. We're a government agency. A lot of people are interested in our modeling work, so we have to have a very clear procedure for gathering public feedback, responding in a timely fashion. So we're developing a governance plan to open source the model. And I recognize that just by making something open source, that doesn't mean that it's transparent. I mean, NEMS is hundreds of thousands of lines of code, okay? But I think it's a small step in the right direction. In the longer term, I think we also need to think about where we take the modeling from here. I feel like we're at a really critical juncture at EIA for reimagining the future of our modeling program. So one of the things that I did is shortly after becoming administrator and starting in the job is I initiated what I call a blue sky process to fundamentally re-examine our modeling objectives and think creatively about next generation modeling capabilities. The blue sky piece of this is without concern to budget and logistics, right? Set all of that aside. Don't worry about NEMS and where you want to take it, or budgets, or staffing concerns, but we are EIA. Who are our stakeholders? What questions are they asking? What questions should we be asking and answering? And then what, if we look ahead 5, 10 years, what does the ideal modeling framework look like? So this is a conversation that's ongoing at EIA as we speak. Okay, final slide. These are just some of the key takeaways. Again, I started by talking about some of the global and domestic trends we saw. If I were to summarize, I would say, regional natural gas markets are becoming more interconnected. You see a lot more, with that comes more volatility. Domestic and international markets are evolving rapidly in response to geopolitics, to policy, to technology innovation. At EIA, we're committed to providing unbiased data and analysis on the full range of energy challenges that confront us. And then to summarize this last bit on the modeling work, we're working hard to better capture the evolving nature of the energy system. We're working to find ways to better reflect future uncertainty, and we're looking to be more transparent both in our data and our analysis. And with that, I will conclude.
Thanks, Joe. So real quickly, I want to ask, I'm going to keep it limited to moderator's prerogative so we can move on in the program, but I do want to ask a kind of a pointed question, because I don't know how many of you know this, but members of Congress have the ability to actually petition EIA to run scenarios based on proposed legislation. A lot of what you laid out is really interesting because it actually will highlight the uncertainty around any sort of proposed legislation. Have you vetted this with anybody in Congress? Is there any sort of feedback you've taken yet? I'm really curious because...
On emphasizing the uncertainty?
Yeah, because what always happens is, as a policymaker, you want an answer. You don't want a range of answers. So I wonder what you think about that.
No, I mean, no, I haven't, run it through Congress. I mean, we operate independently, and, we're not masking the sort of information that we've provided in the past. We still run a number of cases. The lines still appear on the charts. I think it's, what cases do we look at, and then how do we present it?
That's really good to hear. So I think just big takeaway for me is trying to actually more transparently address the uncertainty associated with any given forecast. It's, for myself and some of my colleagues who've actually done a lot of this kind of work in the past, that's music, right? Because it's hard to talk about things as a single forecast because none of these are. They are scenarios. I wonder if, just real briefly, if you could just pontificate a little bit, because one of the things that I took away as well is that as we're talking about energy transitions, I think it's sort of the right time to think about the way we transition and thinking about how projected futures might unfold. So I wonder how much that's influenced what you're doing.
Just in terms of how the energy transition influences?
Just in terms of the multitude of potential outcomes that we have in front of us, given all the uncertainties in the energy sector. How has that sort of matriculated into your thinking about reimagining the way you're doing outlooks?
Yeah, I think it's influenced it a lot. I mean, I think there's a couple things that drive my thinking. One is looking at what's happened retrospectively, and I think as a modeler that's a really critical thing to do. Where did things go off the rails in terms of my projections? And even if you fix that, doesn't mean that it's going to be the same issue in the future, right? But it's still important to go back and evaluate where you've been. But I think the other part of that, to your point, Ken, is moving forward, right? There's the markets are very volatile. The energy system is under transition. There's a lot of scenarios that can unfold, and at EIA, I want to make sure that we have the modeling capability to look at, again, a very wide range of scenarios so that we're ready to respond if we get a congressional request or we see an issue that we think needs attention.
Great. Thank you. Everybody join me in thanking Joe for being here today. Thank you, Joe. All right, so next I actually want to invite Rob Kaplan up to the podium. Rob he's the former president and CEO of the Dallas Federal Reserve, served in that capacity from 2015 to 21. Prior to that, he was at Harvard, served as an associate dean in the School of Business there from 06 through his appointment at the Fed. And prior to that, he had a 23-year career at Goldman Sachs, holding various roles. You just put all that together, I can't think of a better person to talk about the macroeconomy and the uncertainties in front of us. So Rob, the floor is yours.
Okay, thank you. Thanks, Ken. Great to be here at the Baker Institute. So here's what I'm going to try to do, and I'm going to do it deliberately briefly because I want to take 10 or 15 minutes of questions. I'm going to take the energy transition and put it in context of a larger puzzle. Now, most of you, when you're reading about the economy, and in the Q&A I can go just as deep as you'd like to talk about the current inflation situation and how we got here and all that. But if you follow the news and you read the papers, and I used to live with a group of economists, there's a tendency to be very focused on data. Have you heard the term data dependent? And I think we live in a world, sometimes we don't realize it, where we're so focused on data releases, and the world is full of regular data releases, earnings releases, employment, prices. I call that the bouncing ball. And my experience as, again, a former business person and formerly at the Fed for a number of years, it's great to follow the bouncing ball, but if you follow it too far, you can get easily distracted. So what I like to focus on, and those of you who heard me speak before know what I'd like to also focus on, is fundamental trends, the trends that drive the U.S. and global economy. And so what I'm going to talk about here this morning is the 5 big trends. The energy transition is one of them, but I'm going to put that energy transition in context. So I'll start with the first trend. The first big trend globally in the United States is demographics, and it's particularly the aging of the U.S. and global populations. I wish we weren't aging, but we are. And here, the implications of that aging are workforce growth in the United States and in most developed countries, and I would include in that China. Most countries, workforce growth is decelerating, okay? So just to put it in context, and we talk a lot about Paul Volcker these days, as we headed into the 80s, workforce growth in the United States was accelerating. Most of us in this audience, I speak for myself, the baby boom generation, we were coming into the workforce globally. Why is this a big deal? GDP growth is growth in the workforce plus growth in productivity. That's it. Growth in the workforce and growth in productivity. In the 80s, I'll give you rough numbers, workforce growth in the United States was in excess of 2% during that decade. So when we were tightening monetary policy in the late 70s and early 80s, we could do it with some confidence that we had a demographic tailwind right behind us, okay? If you go to the 80s, the 90s, workforce growth decelerated a bit. In the 2000s, it decelerated down below 1%. As we stand here today in the United States, workforce growth for this next decade looks like it might be 0.25%, okay? That's from, 2.5% in the 80s. And so it means we're starting with a headwind for GDP growth. This is why, by the way, there's a lot of appropriate conversation on how to get more women into the workforce, affordable child care, which allows women to work in the workforce. There needs to be more discussion, although it's a sensitive topic, of immigration. Immigration has always been a key part of workforce growth in this country. We obviously don't have that in size right now, or we don't have the kind that maybe is well thought through and structured. But so the first big driver, and this is true in Europe, it's true in China, it's true in the United States, is decelerating workforce growth. That's number one trend. Number two trend, which helps offset it, is technology-enabled disruption. Okay, now many of you say, well, what's new about that? Technology has been replacing people for our entire lives, right? But distributed computing in the last 10 or 15 years has accelerated the ability for technology to replace people. What does it mean? It means a lot of the jobs that we're used to experiencing in the last 10 years have been replaced by technology. A call center worker today that makes $55,000 a year, those jobs will not exist. We're even talking about people who drive for a living, right? Because of technology and innovation, the driverless car, you've got millions of drivers are going to need to find other jobs, all right? Now, I would argue that technology-enabled disruption has not been our enemy. I think it's been our friend, okay, because it's helped offset a lot of this deceleration in workforce growth. But it's meant that the workers of today, particularly if they haven't gone to college, need to be different types of skills and probably need to go for skills training more than once during their careers. We never had to worry about that, right? But the workforce of today has to be skilled and reskilled. There'll be plenty of jobs, in my opinion, but they'll require more training, more literacy, and this is why education is so critical in this country. And this is why skills training is so critical. But I'm talking about 0 to 5, early childhood literacy, full day versus half day pre-K, secondary education is so critical. Many of you in this audience are working on this. And skills training as a viable alternative to college for many people is essential because, again, growth in the workforce, growth in productivity, we need both. And I will tell you, our educational system in this country is lagging. It's lagging the world, and we've got to fundamentally, so again, two drivers so far. Deceleration of the workforce growth due to demographics aging. Second, technology enables disruption. And then the third, where energy comes into this. And I used to say the third was globalization, okay? And this is before COVID and so on, and a lot of the disruption we've had with Ukraine and Russia and some of the tensions with China. Globalization was also a way that businesses in this country were able to create jobs and move jobs, though, globally to offset the fact you maybe couldn't find workers here because of deceleration. It was disinflationary until recently. And I would argue in the last few years, we're now seeing sand in the gears of globalization. As it relates to energy, we've been very accustomed to the idea, Europe is a great example, we can rely on Russia natural gas, right? We had all sorts of international arrangements which allowed us to think globally, not only about our workforce, but about our energy supplies, our material supplies, metals. Now we're going from just-in-time inventory and being able to rely on those relationships to maybe not. And when I say sand in the gears, this disinflationary force has now all of a sudden become maybe an inflationary force, or certainly not disinflationary anymore. And when we talk about renewables and the transition, which I'm about to get into, in order to make this transition, we need the mining of all sorts of metals. Many of them are not sourced in the United States, they're sourced in China and around the world. Globalization is a key part of this energy transition, okay? For wind, solar, battery storage, electrification of the auto fleet, we're learning, requires substantially more semiconductors. We're starting to realize we better have more semiconductor capacity in the United States. That's why that's happening, okay? Okay, fourth trend. And I would call it the end of the debt supercycle. Okay, and what do I mean by that? Whether we're conscious of it or not, every time we've had an economic hiccup, certainly in the United States over the last 50 years, what have we done? Government spending, cut taxes. In other words, we've leveraged up. We've used leverage and printing money. And what do I mean by that? Pre-COVID is a great example. Pre-COVID, maybe we're at about, I think, 70% of debt held by the public as a percentage of GDP. We're now at 100%. We not only more than spent to deal with COVID, we spent multiples of the GDP gap. The Fed balance sheet went from $4 trillion pre-COVID to $9 trillion. So what are you going to do in the next downturn? You're going to spend more money? You're going to leverage up more? The present value of unfunded entitlements is now $65 trillion and rising. And I mentioned the aging. It means taxpayers versus dependents. The ratio when I was growing up where taxpayers were here, dependents were here, as we age, going like this, all right? You don't want to be highly leveraged going into that, right? And so my point is, back to GDP growth, we're not going to have the ability to use leveraging up to drive GDP growth like we have. We're going to have to find ways to grow the workforce the old-fashioned way. Grow the workforce, improve productivity. And these are not magic bullets. They're slow-moving things, investments we need to make in education, early childhood literacy, probably child care that's affordable, that focuses on literacy, skills training. We need to invest in those things more. I don't hear as much talk about it. We tend more to talk about, well, what are we going to do with financial policy? Well, that maybe has been a crutch we're not going to be able to use indefinitely. And so that leads us to the subject of this kind of the energy transition. How does that fit into this? Now, a lot of these drivers, if you step back and look at them, helps explain why we're facing the inflationary issue we are, by the way. And I'll just mention before I talk about energy transition, we have supply-demand issues on materials and goods, fine, but we also have supply-demand issues on labor. I'm far more worried about the latter than the former. Not that I'm not worried about both. We'll figure out a way to deal with supply-demand issues for materials, but deglobalization is going to make it harder. But the issue that I think is not a short-term issue is supply-demand imbalances with labor. I think labor shortages are likely to be with us for an extended period of time. Why? Because we're aging out of the workforce. Yes, people can work longer, great. More women can enter the workforce, great. But you can't get away from the fact, even with younger generations, workforce growth is decelerating. Now, technology will take care of some of that, but we still have a service sector. We've got people working here today. We haven't found a way to use technology to replace everything. And we've got, if you talk to any hotel, restaurant, service sector establishment, and broadly, they'll all tell you the same thing. Can't find workers. Lowering capacity because we can't find workers. This is a problem that'll be with us for a long time. So in that context, we've got the energy transition. All right. The energy transition, and I'll speak as a layman, and knowing that I've worked in energy now for the last 6+ years because of my work at the Dallas Fed, but I'll still call myself a layman. We have a lot of experts in this science. The energy transition, in my view, is going to take 20 to 25 years, okay? And by the way, I've heard estimates anywhere from as low as 150 trillion to 250 trillion. And we all say, oh yeah, well, let me just remind you, US GDP is $23 trillion, okay? So 150 trillion is a lot of money, all right? And the reason I say it's gonna take 20 to 25 years, what do I mean? We can reduce or limit fossil fuel production around the world, and I'm include broadly fossil fuels, including the things we think of, many things we aren't conscious of that use fossil fuels. But alternatives, for all the money being invested in them, every estimate I've looked at shows there's a gap where there's just not enough alternatives available. We still haven't perfected energy storage. We're not talking much about nuclear either, by the way, anymore. Wind, solar cannot fill the gap, okay? And if you want to treat the energy transition, which I think some policymakers inadvertently don't mean to but are doing, like it's 3 to 5 years, what are you going to do? You're going to create a gap where you limit fossil fuels. We want to rid ourselves of fossil fuels. That's great, and I'm a big believer of it, but the time frame matters. It has to be realistic. Alternatives will not fill the gap, so what happens? You get price spikes on all sorts of fossil fuel related, and not just gasoline, but natural gas and all sorts of other derivative products. You get price spikes, okay? What happens when you get price spikes? Low, moderate income families in this country bear the brunt of it because food, energy, that's my timer, That's for 15 minutes. Food, energy, rent, and God forbid, health care. If the inflation rate in this country is 7 or 8%, for a family that makes $50,000 a year or less, which is about 50 million families in this country, the inflation rate is double digit for them. Gasoline's a big part of it. And the concern I have is every estimate I've seen shows that we are probably as much as 3 or 4 years away from peak oil demand globally. Some might disagree with that, but I've seen enough of those estimates to say, in the near term, if you want to do a proper energy transition, you might need to be having the government encouraging, this is unthinkable, right? Encouraging more fossil fuel production over the next 5 years. And if you don't do that, I talked about low, moderate income families. Poor countries right now are burning more coal. The U.S. is the cleanest oil and gas producer in the world. Sequestration, billions are being spent on carbon capture, sequestration, and ways to make it cleaner. If you encourage other countries, if you limit it here and encourage other countries to produce more, you're going to have a dirtier environment, okay? And you're going to make it very hard for poor countries to get through this. So my only message here, and I've been deliberately brief, and I can go a lot deeper on this, is my message is for policymakers that I talk to, is the UN plan is a great start, but I don't think it's a realistic plan based on all the work that I've done on it and my team has done on it, in that it kind of assumes unrealistically that there'll be something miraculously to fill in this gap, and it doesn't focus enough on human flourishing, low, moderate income families, poorer countries, okay? I used to chair the sustainability effort hard for 10 years, and greenhouse gas emission reductions. I'm a big believer in this. Because I'm a big believer in it, I'd like a realistic plan, a more integrated plan from policymakers that focus on the fact that it's probably going to take 20 years, and let's do it in a way that creates a cleaner environment in the near term. I think rushing it, or assuming it's 3 to 5 years, I think we'll have a dirtier environment, and we're going to do it on the backs of low, moderate income families and poorer countries. I think a more realistic transition. So again, to go back to the beginning, 5 big drivers: decelerating workforce growth, technology-enabled disruption, globalization, now deglobalization. I'm afraid we won't be able to use leverage as the candy to solve these problems and the quick fix as much as we used to. And then the energy transition is central to our desire to create a more prosperous economy. And in the current, if you call it crisis we're facing, you got to have a proper energy transition plan, or else you're going to have unsustainably high inflation, I'm afraid, as part of the puzzle on energy prices. And I think that's going to lead to a dirtier environment, I'm afraid, lack of access, and less prosperity. So let me stop there, and I deliberately have been brief so I can take your questions.
Great. So if anybody has questions, please pass the cards to the aisle, and they'll be brought up to me. So I'm going to start with one. You mentioned in your 5 sort of key points, key trends to keep in mind, that the result of that is we need to be thinking about a plan that is longer in duration. So,
and more integrated.
Right.
In the meantime.
But when we talk about plans, what does that mean? Because typically when we think about the evolution of the energy sector, historically, it's been private sector actors that have been sort of driving the boat. So what do you envision that looking like?
Well, so I'll start with the easy stuff, and there's a lot of aspects to this, but here's the easy one. We've now made it, whether we meant to or not, it's much harder for fossil fuel industry to attract capital, not just on the equity side, but on the lending side. I understand why, okay? The only question is, in the context of an integrated energy plan, and this is heresy to ask this, but we produce 11 and a fraction, I was asking Bobby Tudor this morning for the latest, 11 and a fraction million barrels a day. Should we have a national initiative where we go to all shareholders, we go to BlackRock, Larry Fink, all the shareholders, and the industry, but the shareholders are driving this more now, I think, than the industry. And should we have a goal that we produce a lot more over the next 3 to 5 years? Now, that's not going to be easy to do, and we were talking about this morning. Shale requires investment, reinvestment, 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 but we've got a national, I believe, and maybe a global, I wouldn't say, I used the word crisis, but it might be a crisis. Europe, my lord, has got real issues. Do we want to go back, and at least I'm asking the question, should we be looking at, maybe we should have a national issues, why we push the floor on accelerating alternatives? Should we be producing more oil and gas in the next 5 years? Understanding, yes, it will phase out, these will be stranded assets. And I just want to say, are we asking the question? But I think I'm finding out there, there's not really a safe space to have that debate. I'm part of something called the San Jacinto Project, where we're trying to create a safe forum. I just want to hear the debate. I'm a person, I don't have the answers, but I think you have to be free to honestly ask the questions. And I'm talking about a more integrated plan that gets us through the next 5 or 10 years until alternatives become more viable, technology, battery storage becomes more advanced, and we get farther along in this curve.
So to that point, and I'm going to try to pull a thread through several of these questions that have been brought up to me, but to that point, you mentioned, for lack of a better way to say it, supply chain fragility.
Yeah.
It's kind of been exposed. And
Yes.
deglobalization. So when you think about transitioning over the next 5 to 10 years in a way that is a little bit more inclusive of all forms of energy, what has to happen between now and then to ensure that we get the kind of growth where we can actually successfully transition?
So, I mean, the other worry I have is I spent a lot of time on alternatives. A lot of you here do. But I've gone back through the chain on what the materials are that are required. And I first dealt with this at the Fed on the semiconductor shortage. And I talked to every semiconductor CEO that I could. And what they explained to me is, hey, Rob, you understand greening. This is like, one of them said it's like trying to go up a down escalator. The more we produce, the more demand goes up, and greening is a part of it. What I'm saying here is, let's look at the second and third order and fourth order consequences of the plan. And if materials like from China and other difficult countries are going to have to be mined in order to feed this, let's just take it into account. And we are kind of fortunate. We have a little bit of a balancing valve, which is our own energy production here. Right now, we're sort of taking that off the table to some extent. I'm saying put it back on the table, and let's have an integrated plan, or acknowledge that you're going to do this on the backs of low, moderate income families. I guess that's what does that answer your question? I don't know if it does.
It kind of does. I mean, one of the things that I was going to sort of ask in follow-up is the situation in Europe right now. You mentioned sort of putting domestic energy production back on the table.
Yeah.
Do you think what's happening there will serve as a warning shot?
Yes, it is. It's scaring people. It should scare people. And the issue is, remember, let's go through what's going on in Europe. You got the same aging problem in the UK and Europe that we do. Some cases worse. Germany's population is actually shrinking. Ours is at least growing. Okay, and so what they're finding is, there's a big headwind on economic growth, but right now, remember, in the context of the world, we're trying to tamp down economic growth. So can I just give you a couple of statistics that give you a sense why this is happening in Europe? In overcoming COVID, in the year 2019, U.S. nominal GDP growth is 3.5%. 1 3/4 real, 1 3/4 inflation. What was nominal GDP growth last year? 12% in the United States. It was triple what it was in 2019. Same thing in Europe, in that a lot of the growth, because of fiscal policy and monetary policy, we jacked up nominal growth. A lot of it's inflationary, and so Europe is dealing with that right now, and they've got the same labor shortage issue that we do. And so at the same time, you're trying to tamp down demand a little bit and get nominal growth back down to 4 or 5, not going to feel very good. You've got this issue where you've got these price spikes in energy at the same time. And so I'm sympathetic to these issues, but then you need to think back. If you're in the middle of this kind of crisis and dilemma, you have to think with a clean sheet of paper, what are all the options you have to deal with this crisis? And I'm just saying, let's put a few more back on the table, including in Europe. And yes, it should be a warning sign to us that we need to help each other and we need to put a few more variables on the table, because this is a very challenging situation we're facing, very challenging.
So you're basically talking about leveraging the full portfolio of energy options.
I'm afraid, including, and I'm no expert, including nuclear.
That's actually, I'm glad you brought that up, because I think I've gotten 6 cards with a question about
Yeah,
nuclear.
has to be at least discussed. Now you say no, okay, that's all right, but fine. If you say no, 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 then just accept while you're trying to tamp down nominal GDP growth, your your wealthy people will get through this. You will be fine. The people that are wealthier will be fine. It's the people that make low, moderate incomes, which is a big part of our population and the population in Europe. They're going to be overburdened. Now, maybe you can do something to help them, but what, are you going to give out more government money, more fiscal response while you're trying to, do you really want to do that? It's complicated as could be. So I'd say maybe yes, maybe you should be more open to these various options, because we're dealing with a range of lousy alternatives, and all of them are going to be problematic. Put them back on the table.
So I think I've got time for one more question, and this is going to kind of dig into, I think, what you figured you would get asked about. But
Yeah.
You mentioned the U.S. economy effectively being over-leveraged.
Yeah.
How do we fix that?
So I used to say when we were at 70% debt to GDP and 65 trillion in fund entitlements, I'd say, it's unsustainable, I said. And now we're at 100%, so I guess I'll second that. So seriously, how do you deleverage? It's not by cutting. There's a number of things. Growing faster, grow the workforce. This is where immigration debate, as sensitive it is, has to be put back on the table in this context. If you want to deleverage, you've got to grow the workforce, okay, and you've got to improve productivity. And yes, you're going to have to flatten the curve of probably spending. Now, many of you know the deficit numbers have improved over the last year or two, but why? We had 12% nominal GDP growth last year. It's not, by the way, this year is as scary as this year feels. Nominal GDP growth this year, something like 9%, 8 or 9%. In order to get inflation back down to 2, so low, moderate income families can make ends meet, you got to get down in the range of 4 or 5. We got a ways to go. And so to that point, you're going to have to tamp down the forward obligations. We're going to have to stop. Our knee-jerk cannot be more fiscal, more printing. And we're going to have to grow the old-fashioned way, which is not easy, workforce growth and productivity growth. A lot more conversation about education, skills training. That should be at the lead article every day, more than financial gimmickry.
So in that regard, is history repeating itself a little bit, do you think? You mentioned Volcker, so I'll just go there.
So here's the problem. So I joke around, anytime you see a leader in any kind, refer back to an era 10 years earlier, 15 years ago, beware, because you want to learn the lessons, but that's not the right template. Here's why. So for example, in the same way I felt in 2020 and 21, don't use 2012 as a model for what we ought to do now. It's different, okay? In the same way, Volcker had 2 things going for him. It may not feel like it I lived through it. He had a demographic tailwind, and they knew it, okay? And second, we were in a fraction of the percentage of leverage at the government level that we are now. We are so much more highly leveraged. So you've got to understand, if you do exactly precisely what Volcker did, and tough, you don't have the pickup coming in terms of fiscal capacity. Remember the Reagan tax cuts? We don't have the capacity that we did, and we've got a demographic headwind, not tailwind. That doesn't mean you shouldn't learn some of those lessons, but that's not the template for what we're going through now either.
Very good. Everybody join me in thanking Rob. Thank you. So Megan, I'm going to invite you and your panel up.
Careful, that's not even.
Thank you. Well, it's not. All right, good morning, everyone. I'm excited to continue the conversation. It's been a great presentation so far. So my name's Megan McKelvey. I'm a partner in the Energy Litigation Group here in Houston at Baker Botts. It's an honor to be moderating this panel. With me to my left, immediately, Rich Burns is the Chief Infrastructure Officer for Port Houston. Helen Curie, who is the Chief Economist for Conoco Phillips. Then we have Mark Finley, who's a Fellow in Energy and Global Oil for the Baker Institute. And at the end, Megan Nutting, who is the Executive Vice President of Government and Regulatory Affairs for Sonova Energy Corporation. So I guess if we could start just, I always think it's more interesting for you all to tell everyone here a little bit more about yourself than me reading a long bio. So if you could each take, 2 or 3 minutes tops and tell everybody a little bit more about your background and what you do.
Sure. Thank you very much. And thank you for having me here at this prestigious forum. I'm the infrastructure officer at the port, which means I'm not the economist. So we'll talk about the economics and the macro trends that we just heard about. I'll try to keep my comments a little bit to, the on-the-ground realities of Houston and the energy sector and the petrochemical complex that is going to be driving a lot of things around this energy transition and so forth. Engineer by background, management and policy background as well, so I try to know a little bit about a lot and connect dots, which is really one of the major roles of the port as far as energy transition goes today. So thank you.
Helen?
Good morning, everyone. I'm Helen Curry, a Chief Economist with Conoco Phillips. So I'll make a quick plug for Conoco Phillips. If you're not familiar with us, we are the world's largest independent E&P company. We have production of roughly 1.5 million barrels of oil equivalent per day, and we're active in around 14 countries around the world. We are a pure upstream company. As many of you know, we spun off our downstream a little over a decade ago. What I do, what my team does today is largely focus on anything from where oil and gas markets are in the here and now. So we provide a lot of guidance to our management team on where oil and gas markets are going in the near term. And then we wander out further on the time horizon to 30 years, and we have a series of global energy scenarios that we utilize in corporate planning at Conoco Phillips to help shape our longer-term strategy, or strategies, I should say, plural, to recognize what are the potential ups or downs or both for oil and gas, as well as other opportunities that we may have along the way in the energy space. So look forward to being part of the panel this morning. Thank you.
Mark?
Thanks, Megan. Hi, everyone. I'm Mark Finley. I'm from Washington, D.C., and I'm here to help. That's usually a reaction I get outside of the Beltway. I'm a fellow here at the Center for Energy Studies, and it's the culmination of a career spent at the intersections of energy, economics, and national security. Before joining the Baker Institute 3 years ago, I was the senior economist in the U.S. for BP, and presented BP's annual work here at the Baker Institute, for many years. At BP, I manage the annual statistical review of world energy, so data collection, Joe, as well as both the short and long-term oil market analysis, and also had the a role in the overall preparation of the BP long-term energy outlook. And so, while I have a focus on the energy, on oil, I have oil within the context of the whole energy picture and thinking both about the data, short-term issues, long-term issues, and how it connects with economic and broader business themes. And before that, I was an energy security and Middle East specialist at the CIA for 13 years. And so I've been thinking in various formats about the role of energy in our economic and strategic well-being as well for much of the last 40 years.
Excellent. Thanks. Megan?
It's good to be here. Megan Nutting, I'm the Executive Vice President of Government Regulatory Affairs at Sonova. We are a solar company based here in Houston, believe it or not. We're a residential solar and storage service provider. We operate in about 40 markets across the U.S. That includes Guam, Saipan, Puerto Rico, so states and territories. My team and I work on regulatory and legislative policy in all of those 40 markets and at the federal level as well. I've been working on distributed solar policy for about 15 years now, about as long as it's really been around.
Thanks. So our panel, the topic of our panel is macro risk in the energy landscape, and I was chatting with some folks last night about, preparing for this and kind of joking, boy, there's just nothing to talk about on that subject. But I do want to start kind of on the economics point. So Helen, starting with you, if there is a recession, or if we're already in one, as many people I think would say, how would U.S. producers like Conoco, Phillips, and others react to that? And what would you expect to see?
So in terms of are we in a recession, if we sort of address that for a moment, clearly if you use our traditional definition of a recession being 2 consecutive quarters of GDP contraction, the U.S. has already been in a recession for half of this year. And we may be headed even for some more negative numbers in the next quarter. We shall see. But in terms of how U.S. producers or how U.S. production is likely to respond to that, there are a couple of ways to think about that. For many companies, we tend to take a longer-term planning horizon, so we're not necessarily changing the drill bit or changing our number of rigs running or frac crews just based on short-term dynamics. So the key thing that most producers are going to be looking at is what is the longer-term horizon, and how do you come out of this recession? What is your point of view on commodity prices coming out of that? So it tends to be at least on the short side, I would say 1 to 3 year kind of time horizon for some operators, but for many others, and my company being one of them, we're looking at more like long-term, 5, 10, longer horizon type of points of view on prices, and that governs our capital allocation decisions.
Okay. Just following up on that, the point you made about commodity prices, I guess classically one might think that during a recession, prices would come down, but that certainly hasn't been what we've seen so far this year. Do you expect this to be an atypical recession in that regard for U.S. production or commodities prices?
It could be, insofar as oil especially is a globally traded and globally priced commodity and market. So a slowdown in the United States doesn't necessarily move the needle for the global oil market. It can, but not necessarily. Today's situation is different in the sense of there are obvious elements that are unusual occurring in the European market with Russia's supplies and how the whole world is responding to that in the upcoming sanctions. But it's certainly possible for us to go through the next 12 to 16 or 18 months with the U.S., let's say hypothetically, remaining in a recession, but commodity prices, oil, gas, probably coal as well, being at price levels that are higher than what many of us have become accustomed to.
Mark, just switching to you, I guess I would start out asking, what stood out to you as sort of the most significant risk to the energy industry or energy markets of sort of the 5 trends that Mr. Kaplan just walked us through, which were very interesting?
I think you need to separate out the time horizons here. I mean, in the short term, I feel like, you know, the biggest risks in the system are around the Russia situation still. I mean, Russia is, and what's unique about this disruption is that it is a broad spectrum run. You know, for those of us who've grown up in this space, we're used to thinking about, well, a hurricane impacts production in the Gulf of Mexico or refining, or there's an oil embargo, or there's a cold winter. And here what we're seeing is that, you know, Russia is not only the biggest exporter of natural gas in the world, second biggest exporter of oil, a major exporter of coal, and an exporter of important metals, along with Ukraine, a major exporter of grain as well. And so it's a much more generalized commodity shock than we're used to. And there's still room to go. I mean, we don't know what's going to happen with Russian export volumes in the face of a looming EU embargo. You know, there was just an incident on the Nord Stream pipelines yesterday that, you know, many of the European countries think was sabotage. You know, the U.S. is attempting to lead an effort to put a price cap on. The Russians have said, fine, we just won't sell it at all. See how you like that. Yeah, and so, you know, and in with all of that, you have, you know, I think one of the less appreciated dimensions of the crisis that we've been through in the last year is Russia's newfound alliance with the so-called OPEC Plus group, you know, and their ability to keep, you know, those countries from kind of riding to the rescue by increasing production from their spare capacity, you know, to mitigate a tighter market. So I can easily imagine situations where, you know, we're not out of the woods yet in the short-term risks to the energy sector, you know, because of the way the Russia-Ukraine situation plays out. Over longer time periods, you know, I think, you know, Mr. Kaplan was exactly right that, you know, I think this notion of, you know, deglobalization combined with, you know, the aspiration to pursue a rapid energy transition could very easily lead to more volatility if we don't manage it properly. But therein lies the opportunity as well. And I just, you know, published a paper recently with my colleague Anna Mikulska, who I think is here, you know, on how to make this crisis into an opportunity, you know, by having an honest conversation about the need for a functional energy system, you know, that provides affordable, secure, reliable energy today and at each discrete point in time through the energy transition.
Great. Rich, I'd just like to switch to you kind of with the more boots on the ground focus and what you're seeing in Port of Houston. How are these broader economic trends, interest rates, inflation, recession fears, but a strong desire and support around the energy transition, how are things, you know, impacting you, boots on the ground standpoint?
So I think it's kind of, I'm going to key on one of Mr. Kaplan's trends as well, which was the technology-enabled disruption, right? As well as his pointing out that the gap isn't going to be filled in the next few years. That gap is going to be filled by technology development across the entire value chain, and I'll focus a little bit on hydrogen. You're going to hear more about it tomorrow. The developments across hydrogen will serve mobility sectors, they will serve residential and industrial, and then there's a big export market. But how does that happen without sort of de-risking the business decisions that have to make it happen? And from a boots-on-the-ground example, one of the prime drivers of early demand of hydrogen is going to be in the mobility sector. It's going to be in trucks. But how do we get truck drivers to buy into a vehicle that costs 2.5 times what a diesel vehicle costs today? We need to be able to either provide the subsidies to accelerate the adoption of that truck. And by the way, I'm not going to buy a hydrogen truck if I don't know if there's a hydrogen fueling station that's going to be ready for me. And the hydrogen producers are going to have to lean in to provide those and kind of match the demand with supply. So again, we can't wait. There are predictions that the price of trucks are going to come down by 2030. But if people aren't buying trucks and increasing the production function of the vehicles themselves, those prices won't come down because it will be imaginary demand. On the ground, the mobility sector, that's one element. On the ground, the trucking sector, the shipping sector, transitioning to alternative fuels, whether it be methanol or ammonia. These are things that take policies to support the investments, and basically, in a word, it's about de-risking the business decisions associated across the value chain.
And since you brought up hydrogen, and we've all seen the exciting news about Houston becoming a hydrogen hub, could you talk a little bit about what you know of the timeline for that very large project, and sort of any specific challenges that you see to that, and how that would play out here in Houston?
No, absolutely. And we've been part of a large group working with the Center for Houston's Future, and I don't want to steal Mr. Tudor's comments tomorrow, but they've come up with a forecast of 21 million metric tons of hydrogen production, half of which is going to be an export. But as Mr. Kaplan said, this transition may take 20 years to be realized. There are lots of opportunities. I've mentioned the trucking sector. There's an export market of Houston to the rest of the world. A week ago, we had meetings with the government of Rotterdam to focus on exporting hydrogen from Houston to an import function in Rotterdam. Now, that's going to lead to a question about technology enablement, because I guess the leading suspect for transporting that hydrogen will be via ammonia. And there are still uncertainties in terms of the technology to crack the ammonia back into hydrogen on the other side, issues around transport. There's folks in the audience here that are in the ammonia transport business, and they're very sanguine about the markets. But again, if we're talking about risks across the energy landscape, it's really about de-risking the decisions to either build the plants, build the hydrogen manufacturing, coupling carbon sequestration with hydrogen production so that you can have blue turn to green, and then green hydrogen, the question of nuclear and these other kinds of sources for electricity. And I'll go back to the first presentation as well. There was a chart that talked about the electricity supply over the last 8 years and how it's transitioning in terms of the source of production. But the top of that bar was fairly flat. There's a big question about if we turn on an electricity demand for electric trucks or the electricity to create green hydrogen, where's that electricity supply going to come from, especially in a state like Texas that is having its own challenges in terms of electricity production.
Do you foresee any challenges around, one of the broader risks that I thought would be good to talk about is permitting risks these days. So be good to get your perspective on that relative to the Hydrogen Hub project. And then Helen, I think it'd be great to get your take on that as well for large capital projects for producers.
Yeah, I'll just comment very quickly on permitting. Infrastructure is not an overnight type of activity. It takes investment, and luckily the industry has been investing in infrastructure since the shale revolution drove demand for resins production and LNG exports and things like that. Those plants don't get built overnight, and there a lot of planning and permitting applications can be put in place at great expense. If the permit is withheld, then that's a risk that the investors need to consider, and it's been a challenge. Some projects have been canceled or their permits have been delayed, and I'm not talking about only in Houston, but across the country, across the Texas coast. So that's certainly a real risk for operators who are investing in not just billions but trillions of installed infrastructure.
Right. Helen, your views on that? I mean, and we also just saw the news yesterday that the permitting reform bill that Senator Manchin had proposed. Looks like it got pulled. So I just wonder if you have thoughts on that from your industry.
Yeah, sure, and I would build on Richard's remarks regarding these pieces of infrastructure don't get built overnight. That is a piece of reality that we are continually working to help our policymakers, both at the state and the federal level, understand that these changes that they often talk about wanting to happen in the energy space take years to bring to fruition, and there are a number of different tentacles that go into influencing those outcomes. But more specific to the permitting aspect of that, I would say the oil and gas industry continues to face challenges. Just to be candid, that continues to face challenges, and having appropriate turnaround and reliability on permits, even when they're issued, as is well known. There are multiple examples of federal judges coming back later and saying, no, this needs to be redone, that needs to be redone. And that inevitably introduces just a whole other level of risk into those projects, and consequently delays them. Since you mentioned Senator Manchin, it's easy to point to the Appalachian Basin and the need for more gas takeaway infrastructure out of that basin. That is not a new issue, but the inability to get even expansions of pipelines out of Appalachia just continues to in some ways, plague the producers that produce there. My company is not active there, but it's well known the capability of the resource in that basin, but you can't get more out without more pipelines.
If we could just switching gears a little bit to renewables, Megan, there's so much to talk about there, and just front and center in my mind is that clearly, I think in our conversations almost every day, there is huge broad-based support for the energy transition, but then we sort of look around and see what's happening in Europe, and like Mr. Kaplan said, it is scary, it should scare us, and it should be a warning. Maybe they swung the pendulum too far too fast, and we're seeing them pay the price for that. So in your view, what is a sensible yet aggressive approach to achieve these energy transition goals in a way that it balances things with energy security? And I would also agree with the comment earlier that the timing matters. And so I wonder if you could speak to how fossil fuels and nuclear and renewables can work together to move forward to that, and the pace as well.
That's a lot of questions. I think, so starting with Europe, I think I take away maybe a different perspective from that. Europe is incredibly dependent on Russian gas, now is being cut off from Russian gas and is facing some energy crises. Had Europe transitioned more quickly to a different type of energy that was domestically produced and used, they wouldn't be so worried about the costs of gas and access to gas. Natural gas, this audience knows this, is a global commodity. We've just been talking about this. And the US is one of the largest exporters of natural gas. At the same time, this industry is very dependent on unstable and despotic governments, Russia, Venezuela, Saudi Arabia. Whereas when you think about renewables, they are built locally and that energy is used locally. At this point, for the most part, it is cheaper to build and run a utility scale solar plant than it is to just buy the fuel to run a natural gas plant. So when we talk about security, prices for consumers, we've all seen retail rates go up. Mine have gone up 40% recently. In Puerto Rico, rates have doubled since just 2020, so in the past less than 2 years. And according to the EIA, that's primarily because of natural gas prices driving wholesale rates and then therefore retail rates. Those prices are up about 200% in the past couple of years. So when we think about how do we make sure we have access to the energy that we need and that it comes at a cost that's reasonable for consumers, to me, the answer isn't do more of the same, more of what we've been doing. It is make that transition happen more quickly. We're at a point where renewable energy, I think it's projected to provide about 24% of our energy next year. That's more than coal. So I think at this point, it's probably time to stop calling renewables alternative energy. We are very mainstream at this point. Hopefully that answers some of the questions.
Yes. And just while you're sort of on that subject or somewhat related to it, there was have been some concerns about the equities of renewable. It's expensive to buy a Tesla, or low and moderate income families couldn't necessarily afford that, or potentially to install solar panels on their homes. But you're much closer to that. Is that really true, or do you have a different take on that as well?
Yeah, we think about equity a lot. Obviously, we all should be thinking about equity a lot. It should be front and center in all of the conversations that we're having. One of the top equity issues is communities that are affected by burning fossil fuels and the health outcomes for those communities. No one wants to live next to a fossil fuel plant, but I have neighbors with solar. My house has solar, and none of us have problems with that. So I think the health of those communities should come first and foremost. Second of all, as we think globally about global populations and the impacts of climate change on those populations, Swiss Re, so not a super lefty think tank, but Swiss Re has projected that if we don't meet net zero goals by 2050, global economic growth is projected to go down by 10%. For comparison's sake, at the height of the COVID pandemic, growth went down about 5%, and in 2008, during that recession, it was about 1%. And so all of those countries and all of those people will be very affected by that decrease. Asia is expected to go down about 27%, have a decrease in growth. And so if we aren't meeting the goals that we've set out for ourselves, we stand to lose trillions of dollars. And it's the poor and the low-income families that will be hardest hit by that. Additionally, those people will be hardest hit by famine, by displacement, by rising sea levels. And on top of all of that, they are hardest hit by rising energy costs. So when gas costs a lot and they have to fill up their cars, or when utility rates go up, when they double since 2020, especially in a place where you can't really depend on energy provision in the first place. So I think low-income families will be hardest hit by not moving this as quickly as possible. As far as access to solar and EVs, once again, we can all always do better. At this point, I think the cheapest EV on the market is $25,000, and the government just passed a $7,500 tax credit, which makes, so it's sub 20. You can have access to an EV for sub 20, depending on your income, which is great that it's targeted toward lower income families. As far as solar access, something like 42% of households in California that went solar last year made under $100,000. And I think another 25% made under $150,000. The vast majority of our customers are low and moderate income. We offer financing options for customers, so you don't have to pay cash to put solar panels on your house. You sign up with us and you immediately start saving on your electricity bill. If you have a battery, then you have access to electricity, whether there's a freeze or a hurricane. And so you keep your family safe. You're not subject to a $17,000 bill if there's a surprise freeze. And solar's, it's inflation proof. I mean, you don't pay more for the fuel over time. The fuel costs what it costs. And so I meant to mention on the timing, how do we do this and what should be the mix? I think there's a lot of hubris involved in thinking that any of us can control what that will be, right? Technology will control what it is. Consumer demand will control it. Markets will decide, and of course, government subsidies. At this point, the IMF has said that governments are subsidizing fossil fuels to the tune of, I think, $6 trillion a year, $11 million a minute. So those subsidies definitely sort of distort what the market looks like. But that combination of things will decide how quickly we move. And the thing is, we need to move pretty quickly. If we've already had about I think a degree of warming so far. At another half a degree, we can expect twice as many plant and animal extinctions, 10 times as much sea ice melting. If all the countries in the world meet the goals they've set out right now, we'll have a warming of 3 degrees, and humans have never lived in a world so hot. So when we think about how quickly this should go, it's going as fast as people are demanding it. And meanwhile, it needs to go as fast as possible. I mean, we're talking about the survival of our species. Someone mentioned Larry Fink earlier, and he said something like, we should focus on sustainability not because we are environmentalists, heaven forbid we be environmentalists, but because we are capitalists and good fiduciaries for our clients. And so I think this transition is happening quickly, needs to happen as quickly as possible, and it makes sense. And it is equitable for it to happen as quickly as possible.
Thank you. Helen, from your perspective, kind of coming more from the fossil fuel side of the industry, what do you think is sort of the right pace or a reasonable timeline to achieve these objectives and the opportunities to work together with renewables in that process?
Sure. So let me start by stating that when we look at the global energy mix, we absolutely see renewable, both solar and wind, increasing at a more rapid pace in the coming years. But in addition to that, among a range of scenarios that we examine, both internally created and looking at every externally generated scenario, whether it's EIA or IEA and a host of others, we do observe that there is a high likelihood, nothing is certain, but there is a high likelihood that oil and natural gas and other fossil fuels will continue to be needed in order to sustain global economic growth as well as meet energy demand. I think it's also important to point out in this, maybe is starting to kind of move towards the conversation about equity, is if you have this conversation in other parts of the world, it takes on a very different tone in terms of pace. I've sat in rooms where people from emerging markets, particularly those in several in Asia and Africa, will tell you very, very candidly, we don't view it as equitable to tell us to decarbonize before we've even carbonized. So I think that's a very powerful way to just step back and recognize that we in the United States and Europe can have and do have one perspective on this, but there is a large part of the world, which by the way has most of the population of the world, that is coming at this from a different starting point. So I bring all this in to come back to the question of pace. And so we think of it as, well, one, I don't have a particular answer for what is the right pace. It's not anyone's place to say. But I think what we all need to try to come together on is that we very likely have a wide array of agreement on the destination, net zero. But by when? And what does that look like? So it's more about how quickly do we get there and what pathway do we take to get there. But we're all working to get there. In the interim, companies like mine are focused on producing the oil and gas that the world is demanding, and doing so in a sustainable, low GHG intensity fashion, and delivering those products and being reliable.
In that sense, is it possible to view the Russian invasion and Europe's move away from Russian gas as creating more of an opportunity for U.S. producers and, to Megan's point, to get moving more quickly on this?
Well, I think you're seeing that it has created an opportunity or a market opening particularly for LNG exports. Of course, the U.S. has been exporting coal as well, and Europe will burn more coal this year than probably they've ever burned before. as a necessity. There are opportunities that have come about out of this. I think what's still hard or difficult to discern is how hard and fast are the Europeans going to hold to moving in one direction versus another. Put differently, we hear the same things you and others hear of some European leaders saying this means we need to move faster away from fossil fuels, while concurrently others are saying, well, actually, no, maybe we need to step back and reassess, particularly with respect to nuclear. And I know the topic of nuclear power was brought up earlier. But so there's still a lot of uncertainty there as to how this is going to play out.
Mark, follow up on that?
Yes, thank you. I think the situation in Europe, and to a lesser degree, we're all living through it as a result of the turmoil in global energy markets, is kind of a reminder that governing is hard. There's a lot of different objectives that society and voters have. It's a sustainable energy system, and national security, or jobs, or equity. Where do these prerogatives line up and pull in the same direction, and where do they potentially conflict, and how do you manage those choices? I think the irony is that coming out of where we've been in the last year or two, we're likely to see, relative to where we were before, a faster transition and more investment in oil and gas. And actually, I think that that's okay. If you look at, for example, the IEA's net zero scenario, they show worldwide oil demand falling to about 25 million barrels a day by 2050, and yet still requires new investment in oil production and natural gas production, because of the decline rate of the current base. And so the idea that actually you need to invest more in oil and gas, even as you invest more aggressively in the transition, is, I think, something that we're being forced to recognize, by the reality of the pinch that we're in at the moment. And I think it could be channeled in a constructive way if we're willing to have that honest conversation.
And just thinking, for example, one area where you would need both is, EVs come to mind. If I'm going to plug an EV into a battery at home, I need, power plant somewhere providing the electricity to charge that vehicle. Do you, I guess, relative to the surge in EVs and other things going on in the energy market, see gas overtaking oil? And it was, I think, mentioned in a prior presentation about oil peaking in, the next few years.
People have been calling for oil to peak for a long time. Megan would know more about this than I would, but I think the concept is you have the electric car and you have the electric generation being provided by renewable sources. Renewables are 24% of U.S. power generation today, but natural gas and coal are still 50%. And that's, in a country that is, way ahead of the world average. Globally, globally, nuclear energy provides 4% of the world's total energy mix. Hydroelectricity is about 7%. Other renewables, largely wind and solar, are about 7%. And whatever the math is, the other 82% is fossil energy today. And so the question is, we kind of need all of this to have a functional energy system at the moment, and we have to make sure we invest in maintaining that functionality as we progress. Will natural gas surpass oil? I fall back on one of Joe's comments earlier about the need to be humble. The range of possible outcomes, even in a successful net zero scenario, varies dramatically depending on what the modeler's assumptions are. What wins? What's the technology that wins? Is it energy efficiency? Is it renewables with batteries? Is it nuclear? Is it carbon capture and sequestration? I have no idea what the answer to that is. What I have confidence in is that people are pretty creative, about finding solutions when they're given the right incentive. I think that's the one truly inexhaustible resource we have is human ingenuity. And so the trick is, how do we line up a system that provides the right incentives, to have a rapid transition to a more sustainable energy future while still maintaining a functional energy system at each point in a way that kind of frees up the creativity to find the unexpected answers, that none of us anticipates today.
Sounds like some of what you're saying is that we need not just the private sector to drive the innovation forward, but we do also need government policies behind that are sort of laying the foundation for that. Rich, are you seeing that play out successfully at Port Houston as it's moving to become cleaner, more sustainable?
Yeah, I think that, as I said before, these transitions aren't going to happen without a stimulus, whether that's a policy that supports zero-emission vehicles or whatever. The policy angle is going to be very important, but it's also, we need to be realistic. Even inside the United States, we've got different policy drivers in different states. Texas is much more a free market, and it's about whether all the opportunities that Mark just mentioned have a profitability and an economic value proposition. They're going to work faster here as opposed to a state that regulates and mandates the use of hydrogen or the use of, in the ports, shore power, these types of things. All of those technologies can happen here, but they have to have more of a profit motive and a clear value proposition. And so I think that there's a prime the pump role for the Jobs Act and the Inflation Reduction Act, but that is billions of dollars when I heard somebody say 150 trillion is going to be required. So the real money is going to have to come from investors in real businesses that make sense. Here in Houston, just a mile from here and sponsored by this university is the ION, and across the street is Greentown Labs. There's a lot of innovation happening here, and that has to be leaned into. I see a lot of private money investing in those startups, and I think there's a balance between the public policy and the private. The other risk also, I think there's two. One of them is policies can change, right? There are still detractors from the current incentives that are in the bills that just passed. Those may be reversed depending on the political winds of this country. And the other risk is, I guess let's call it collaboration, and that word is overused, but there's a well-known 11-company consortium seeking to do a $100 billion carbon sequestration project. That's 11 companies with 11 teams of accountants and lawyers and engineers that have to get together, and no policy is going to accelerate that conversation faster than the CEOs themselves saying we need to make these kinds of things happen.
Thank you. Coming back to Mark, some of the kind of interesting things that are going on right now and seem to be impacting the energy markets quite a bit are what's going on with OPEC. They have not been injecting more supply, even as demand in Europe is at an all-time high. That's internationally, and then also what's happening with the SPR here in the U.S., and I just wondered if you could touch on both of those things and the risk or opportunities that's posing for energy.
I think some of the kind of old pillars that we've all relied on in the oil market are changing under our feet. And these are all the points you raised, Megan, are demonstrations of it. When Iraq invaded Kuwait, Saudi Arabia said, how much can I increase production, how quickly? And when Russia invaded Ukraine, Saudi Arabia within the OPEC Plus group said, we're nothing for us to see here. We're just going to kind of stick with our plan of kind of very cautious, measured restoration of production cuts that we had put in place during COVID, and that's what we think is the right thing to do. Even after the president and other consuming country leaders asked for accelerated production. So I think that something has changed. Whether it's, the bilateral relationship the United States has with these countries, whether it's their relationship with Russia, what combination of those, new leaders, all of these things, I think, are coloring this kind of changed level of engagement. And then on top of that, you have, the coordinated release of U.S. and strategic stocks from other members of the International Energy Agency as well. The U.S. has released oil from its strategic stockpile at a pace that is without precedent over the 50-year history of the SPR. Just in the last year, the U.S. has sold about 200 million barrels out of the SPR. That's equivalent to adding 750,000 barrels a day of new supply on top of what's been going on in the marketplace. How will that be managed going forward, and what are the rules of engagement? We'll have to kind of see how these things shift. And by the way, that's all we've talked about is oil, and the reason for that is because the world's energy security framework has been built up over 50 years around oil. As much as we criticize that system, it doesn't exist for any other form of energy or for the bare base minerals that are needed for the energy transition. So there's no strategic stockpile. There's no treaties that obligate countries to coordinate. There's no countries dedicated to maintaining buffers of spare production capacity. And so I think the idea that we need to kind of broaden our energy security framework to include other forms of energy and the critical minerals that are needed in the energy transition, is a really important thought. The good news is I think the U.S. government and others around the world are moving in that direction, but it's very early days still.
Okay. We're getting close to the end of our panel time. We're not quite there yet, but if there are questions from the audience, start sending up the cards and I can look through those. Megan, on that last remark about key minerals needed for the energy transition in your industry and solar, can you talk about some of the kind of primary risks to your supply chain and your business?
Yeah, well, for the most part, for solar panels, they're pretty abundant earth minerals. We need aluminum, glass, silicon. It's all some copper. For the most part, that's pretty abundant. On the battery side, because we include that now, since dispatchable solar is obviously more valuable, a lot of manufacturers have started changing from lithium-ion batteries to lithium phosphate because phosphate's easier to get. So supply chains are shifting, and a lot of what sort of goes into to a lot of the panels and the batteries and the balance of systems that are needed are fairly abundant. Like with anything, there's it is an extraction industry, and so there are always challenges associated with that, especially when some of those extraction locations are challenging. For example, we get a lot of polysilicon from China. The world does. The world gets 95% of its polysilicon from China. That goes into solar panels as well as a lot of the technology that we all use on a day-to-day basis. And so shifting, being cognizant of what those supply chains are and making sure we shift them and are thoughtful about the countries that we partner with, as we're all aware on the oil and gas side, that can get tricky. So making sure that, that our partners are strong partnerships, and that we do as much domestic production as possible. And that was one of the most valuable parts, I think, of the Inflation Reduction Act. There's a section in it that supports domestic manufacturing along the supply chain. So polysilicon, ingots, wafer cells, modules, and then balance of system inputs as well in batteries. So we're working on building up a domestic supply chain, which I think, once again, will just contribute to energy security when we can buy those components and materials and then final products locally here.
When we think about wind and solar becoming a bigger part of the portfolio of how we consume energy, it is true that it's intermittent. Sun doesn't shine at night, wind doesn't always blow. How do you manage through that and address that risk or concern in the energy market?
Yeah, definitely. You cannot always count on any type of energy source, right? And during the Texas freeze, I think 87% of the outages were the result of natural gas failures. So you can't always depend on that. The Vogtle nuclear plant in Georgia is 6 years over time and $16 billion over budget. So you can't always count on that. So every type of energy source sort of has its intermittency problems. Solar and wind are definitely no exception to that rule. A lot of you are probably aware of this, but 20 to 25% of our energy system is overbuilt to serve 3% of need, just that 3% of when energy is at its peak. One way to think about shaving that, and then not having to overbuild the system by so much and invest so much in that, is on the demand management side or demand side management. You can do that with smart thermostats. You can do that with solar and storage. You can do that with some energy efficiency. One very inelegant example of it happened just a couple of weeks ago in California when they were faced with some rolling blackouts, with some outages. And the head of CAISO texted everyone in California and said, we're about to shut off your power. If everyone could just reduce your usage, that would be great. And people responded to that text message and reduced their usage 2,000 megawatts in just a couple of minutes. And then California didn't have any blackouts. That's a demand-side management solution, obviously not very coordinated, organized, or elegant. So there are better ways to do that. But if you think about how you sort of integrate people into the process, make it a more transactional energy system. Sort of up until now, we've had, or even very much now, we have this command and control system. And a lot of grid operators think of demand as this exogenous variable they must meet with supply. But rather than matching supply to whatever the demand is, what if you match the demand to whatever the supply is? So if the supply is somewhat variable, as it can be with solar and wind, with utility scale solar and wind, you manage that with home energy management systems and functions. And so you lower demand at the home. You say your air conditioning turns on, that maybe you have a mechanism that shuts off your electric vehicle charging. So you charge at night, maybe when wind is really abundant. And so making our system more dynamic, transactional, less command and control and less top down will allow us to then integrate the cheapest form of energy at this point that has no fuel costs and that is variable, and also to manage the other variabilities of other types of energy sources.
Rich, follow-up comments on that?
I'd just like to add, we're in Houston, the global energy capital of the world. There are 500 million barrels of liquid storage along the ship channel. That midstream sector is really big. And those companies don't only think about what they're moving today, they're storage companies. And I've had several conversations with companies that are thinking about the future of energy storage, and whether that be giant battery banks or new innovative technologies to store that energy to increase the resiliency of the grid. That's an important part of this whole conversation and the whole energy system as it's going to develop here.
One last question. Who would be our kind of key allies or key energy trading partners as we look, I guess, in U.S. production, or who we're dealing with outside? Who are the key relationships that we should be fostering or improving in that regard to facilitate our stability here? Rich or Helen, either. I'm sorry, Helen or Mark. I'm looking for.
Well, I guess I would say our best ally is a functioning marketplace. When Winston Churchill was considering whether to switch the British Navy from domestic coal to foreign oil, this question of energy security came up, and his answer was, security lies in diversity and diversity alone. So having a flexible global marketplace actually provides a lot of this that's kind of the first line of defense, I guess I would say. But that's this system of globalization, if we believe that it has benefits, then it needs kind of an active cultivation and defense. And we need to kind of make the case for it and demonstrate the value of it to ourselves and to the other participants in it. And so that's, I think, part of the challenge / opportunity that we face is trying to, if we believe that this system has served our interest reasonably well, in the post-war era, then we need to make the case for it. to continue.
There have been more questions from the audience, but I'll wrap it up there and just encourage anybody that didn't get their question asked because of time to visit with any of our panelists. But thank you all very much. Enjoyed the discussion.
Thank you.
Thanks, Mark. It was always last night was a pleasure.
So we're going to go ahead and take about a 15-minute break before we convene for our next panel. When you think about the sources of emissions from fossil fuels, it's really combustion to drive our cars, to run our power plants, to heat our homes.
If we want to end that, or at least dramatically reduce it, we have to think about other ways to do the same thing that we're doing right now with those hydrocarbons. And electrification offers a really ideal pathway for doing that because we know how to use electricity for moving vehicles, and we know how to use electricity to heat our homes, turn our lights on, and run our machines.
Clean electricity is going to play a pivotal role in the clean energy future. No one has a scenario that gets us to a decarbonized energy system without a great expansion of carbon-free electricity.
Back in the 1800s, numerous inventors were tinkering with electric power, electrification, developing batteries, light bulbs, so on and so forth. And a few were really focused on how to make this a saleable product.
Thomas Edison and Westinghouse developed the technology that allowed electricity networks to be created. And gradually, private companies started offering electricity service to homes and to factories. Many power plants were connected to stronger and stronger, larger and larger networks.
And the acceleration really continued throughout the century. For example, federal investment in dams and big power lines, linking generation facilities and distributing energy further.
The change was really revolutionary. Households were transformed. Factories would triple or quadruple their output overnight. We eventually created a single grid across North America.
The National Academy of Engineering put out a report a decade or so ago where they declared that the grid was the single most important invention of the 1900s. And they've also suggested that remaking the grid will be the most important engineering achievement of the 2000s as well. Electrification is one of the key strategies for getting to net zero. And there are two reasons for this. The first reason is electricity is almost always more efficient than using heat-based processes. The other reason why electrification is important is because the power sector can decarbonize so easily. So by electrification, we get efficiencies in the economy and decarbonization. It's like a win-win.
That's forcing consumer behavior to change, it's forcing generator behavior to change, and it's driving investment dollars into different types of resources. So what was once a grid that was dominated by coal-fired generation, the balance being nuclear with some modest amounts of natural gas, has now flipped, and across the country, on average, natural gas is the largest generating resource across the country. Coal has dropped, nuclear is held pretty steady, and you've seen a rapid increase in the amount of renewables that have been deployed.
So we have real progress going on sources of power. What I do worry about is the difficulties in creating enough infrastructure to balance and deliver that power.
The grid as it exists today doesn't have enough capacity, isn't in the right locations, and may not be in good enough shape to support the kind of electrification people envision for the future. If we are imagining a future in which we are relying exclusively or almost exclusively on renewable resources, and we still want to live where we live and go where we go, we are going to need to reconsider where our power lines are, how much electricity they carry, and where they go. If you look at maps of where the wind energy is in our country and where there's lots and lots of sun, it tends to show places like the Panhandle of Texas, the Midwestern Plains states, and if you look at where our populations are located, we're not necessarily in those places.
So if you have a high availability of renewable resources in the upper Midwest, say, that's a great wind resource, you need wires to be able to move it to load centers like cities and urban communities that are going to consume that energy.
Just getting those in the ground and getting the permits that are required from an environmental standpoint and other legal standpoints can take 9, 10 years in some cases. And some of them have to do with laws on the books and permitting. Others have to do with the not in my backyard kind of syndrome that we all experience. And that's just human nature. We have property rights. We have, landowners. We have concerns around Native American rights. I mean, there are all these things that are legitimate.
If we're going to make our entire economy depend even more on electricity than it does today, then we really need the electricity to be reliable. It needs to be there when we need it. The state of the power sector in the United States is that it's more fragile than we want it to be. We saw this with Winter Storm Uri in Texas in 2021, Hurricane Sandy in the Northeast in 2012, the wildfires in California over several years. And we have to turn it off to prevent a wildfire, or it turns off because the weather is cold. Then we have other risks that happen. We start to lose our medical care system and people die. People die from the cold. There are problems with getting our water treated and clean. We can't preserve our food. There's all sorts of problems with the economy if it depends on electricity, and electricity is not there when we need it.
You think about reliability in a different way when you put that into frame, right? You think about, look, there is a social cost associated with not being able to provide power to the grid. And so you need to have backup sources of generation available on that grid so that you can manage that. Maybe it's natural gas, maybe it's battery capacity, I mean, who knows? Maybe it's nuclear, maybe it's something we haven't even thought up yet. But if we're gonna make these choices to go all electric and only renewables, we've got to pay for the backup too.
So I think there's this balancing act to be had as we want to accept in the electrification of the transportation sector and of other parts of our economy like the building sector. And we want to continue to get less carbon intense over time. But if we try to do too much at once, we could get to a point where we're having reliability concerns. We could also impact the affordability of electricity.
Consumers are willing to pay something. The number changes based on where they are relative to income level. There are a lot of early adopters who are very much willing to adopt the electric vehicles. They have a charging station because they're agnostic to their bill. Their utility bill comes and they pay it. And then you have folks who are working to make ends meet, and they're very concerned about whether or not they can afford to pay their electric bill. So there are some questions about equity and how we're going to ensure that the public will support it and can afford to pay for it as we look at medium to longer term planning.
Electrification has been growing. Today, the rate of electrification in the United States is higher than it was in 1970. So we are moving in that direction already. However, to get from where we are today to a point where everything is electrified is a Herculean lift. The amount of infrastructure that needs to be developed, the amount of offsets, if we talk about nature-based solutions to carbon dioxide for the fossil resources that remain on the grid, the amount of carbon capture that has to be installed and developed, it's staggering.
But it's going to be hard. And again, a lot of different components are going to have to come together. Industries, support from government. We have seen some progress being made, frankly, in a bipartisan way. So that's heartening.
We have the technology and the ability to get most of the way there. The question will be, where does the aspirational goal of emissions reductions meet the willingness of the public to pay and the ability for the system to be converted to that future state with a different set of resources operating in a little different fashion than it does today?
The industry's future has been this bright only once, and that was at the turn of the century when electricity reinvented people's lives and reinvented our economy. And now electricity is half the climate solution and going through a giant renaissance of decarbonizing and doubling its reach. Now, there's lots of other really, really important work to do for the climate solution in every industry, but it is great to see the new sense of mission in the electric power sector.
Amina. Oh, hello. Yeah, it's great to see you. Oh, thank you.
I'm finally here, happy to be here, and I think the last time was
Yeah. Absolutely. No, it's good to see you. Absolutely. So.
thank you for
Yeah.
I'm an R&D.
Yeah.
Yeah. I'm like energy economist, and I'm supporting from our perspective all our business units, energy management, and energy transition.
We should definitely chat. I mean, L.L.P's a great supporter of ours. I know Mike Graff really well, so would love. Let's chat. Let's definitely chat.
Yeah, I'll be happy. So
All right.
right now we're like reviewing all our
Yeah. Of course. Yeah. Of course. Yes. Absolutely. Cool. Yeah. No problem. Oh, no problem. Ah.
I'm sorry.
It's nice to see you. Yeah.
I'm a big fan of you.
Oh, thank you.
I assigned you last year, but I don't have an opportunity to say hello.
No, absolutely.
The one that my president.
Let's find time to have coffee or something. That would
Thank
be
you
great.
so much. I appreciate it.
Absolutely.
Sorry for interrupting.
No problem. Yeah, you too. Okay. Oh, I know. I mean, but I was actually I was in Oslo for Energy Valley in May. So that was a really interesting conference. We should find time to talk about it because one of the things that came out of it were some of the local issues associated with infrastructure development that you don't ever hear about, right? So, yeah. No problem. You did great, by the way. Thank you. Yeah. Well, you got a lot of hydro, which helps. That is the world's best battery. Yeah, that's so. It's yeah. Sure. Yeah. So that is, I would love to chat with you more about that, but I got to get this started. That is, I think there's a massive role for that, right? So, but we can. So, yeah, absolutely. All right, so, yeah, it's on. All right, could I ask everybody to go ahead and take a seat so we can get started? All right, so, excuse me, everyone. I'm going to ask you to actually take a seat so we can get the next panel discussion started. Yeah, go ahead and go up. Absolutely. Thank you. So I gotta say, I love the fact that I'm having to interrupt conversations that have started around, the first half of today. That is phenomenal. It really shows there's a lot of interest, and I think it also shows everybody's glad to see each other again. So, great job. We have a great panel for you. I'm going to hand it over to Travis Wofford. Travis, go ahead and take it away.
All right. Thanks, everybody, for coming. This is a real privilege for all of us, especially to be here with this distinguished panel and all of you today. So to get everybody's attention with maybe a little bit of sizzle, I'll start with something that you've probably seen in the news recently related to our panel's topic, which is financing the future of energy. So at a House Financial Services Committee hearing last week, Representative Rashida Tlaib, a Democratic congressperson from Michigan, asked Jamie Dimon, the CEO of JP Morgan, quote, "Does your bank have a policy against funding new oil and gas products?" Mr. Dimon responded as only he could, quote, "Absolutely not, and that would be the road to hell for America," end quote. So I think in 12 words, Mr. Dimon summed up the thoughts of many. But I'll say if you ask a lot of the oil and gas producers and others in that value chain, they look at current capital costs and spreads and say, show me the money. Representative Tlaib then responded, quote, "Everybody that got relief from student loans who has a bank account with your bank should probably take out their account and close their account," end quote. So I do think that the congressperson genuinely means well in her concern for climate change, but it makes clear that lenders do have their own constituents to satisfy too. We might talk about some of those influences today. The exchange highlights a few key points relevant to our topic on this panel. First, balancing energy security, affordability, and sustainability is hard, and different stakeholders, including the lenders, the borrowers, and those around them will prioritize each differently. And finally, getting to the point of the discussion, no matter which direction we go to the energy future, no matter when we get there or where we wind up, somebody's got to pay for it. So my name is Travis Wofford, and I'm the Vice Chair of Global M&A at Baker Botts. I'm also the Chair of the Houston Corporate Practice, which covers capital markets, leveraged finance, and M&A. We've been serving the energy and technology industries for a little over 180 years now. To my left is Amy Cronus. Amy is Vice Chair, the U.S. Oil, Gas, and Chemicals Leader, and the Managing Partner for Deloitte's Houston practice. Amy has over 30 years experience serving public and private enterprises, from emerging companies all the way up to Fortune 500 companies, with a focus on oil, gas, and chemicals, technology, and manufacturing industries. To her left is Dawn James. Dawn is the Director, Global Industry Strategy for Energy and Sustainability at Microsoft. You may have heard of them. And also a member of the Board of Directors at Greentown Labs and an advisory board member at S&P Global's Carbon Credit Meta Registry. She started her career as a geologist and previously served in technical and advisory roles at, among others, Halliburton, Schlumberger, and Pioneer. To her left is Stephen Miles. Steve, a Baker Botts alum, is a fellow in global natural gas for the Center for Energy Studies here at the Rice Baker Institute. His research includes energy transition issues related to LNG, natural gas markets, renewable energy, and energy storage. And Mr. Miles previously was the head of the LNG team at Baker Botts as a partner for much of his 35 years as a lawyer. To his left is Mari Salazar. Mari is the Senior Vice President and Regional Manager of BOK Financial's Energy Financial Services Group. She has over 20 years of experience providing specialized financial solutions to the energy industry, focused on lending, financial analysis, and portfolio management. She's been recognized for her contributions to the energy industry by Women's Resource of Greater Houston, Hart Energy, and Houston Business Journal. And last but definitely not least is Jeff Tillery. Jeff was a founding partner of energy-focused investment bank Tudor, Pickering, Holt & Company, where he spent 17 years in a variety of research and investment banking functions. Earlier this year, he founded the energy think tank Veriton, headquartered here in the Ion in Houston, with his partner Maynard Holt, where they have the evergreen goal of answering the question, what does the energy world look like in 10 years? So again, the topic of our panel today is financing the future of energy. How's the landscape evolving? We're lucky to have a diverse group of backgrounds here today to shed light on some of these topics. I'd like to start by having each of our panelists share their perspectives of where the current energy and financing landscape today finds us, the lessons that we're learning from these evolving times, maybe where the future of energy may go, and how the availability of financing might meet or fail to meet those challenges. So if you guys can hit all of those things in about 3 to 5 minutes, I think we'll be good. Amy, why don't we start with you?
Sure. And so, as backdrop to our experts who are going to talk about financing, I guess I'll talk a little bit about the financial health to deserve that financing. And, the great news is we're seeing a period of big readjustment for the energy markets. As already mentioned in the previous panels, there's a real confluence of factors that's triggered this. The COVID-19 pandemic, geopolitical developments, underinvestment in hydrocarbons that have pushed energy prices to record levels, causing readjustment in energy markets, trading relationships, organizational priorities, and broader energy market narratives. So what we've recently found, we just recently put out a report, Striking the Balance, talking about that the industry's cash generation is running way ahead of the oil price cycle, resulting in nearly $793 billion of record free cash flows. And so, although current oil prices are at a par with 2013, 2014 levels, cash flows are 3 times higher. And that's really
great.
It's really something. So this is one of its healthiest periods with the lowest ever ratio, 20%, and one of the highest dividend yields, 6%, compared to other sectors. So what we're saying is oil and gas companies are going to likely to continue to prioritize capital discipline and shareholder payouts over undisciplined and inefficient growth. So as a result, which is what hopefully our lenders are very interested in, the global upstream industry is healthy, and it's projected to generate its highest ever free cash flow of $1.4 trillion in 2022. And that was based on an average Brent price of 106. Year to date, Brent's about 98. So although oil prices, we've gotten that question a lot since the report came out. Well, but oil prices are lower now. Yeah, but even though they've dipped recently, we don't foresee a material impact on that free cash flow. It's going to likely remain north of 1.1 trillion, even if, say, Brent prices fell to 65 is an average. So remember, year to date, it's amazing. So that ongoing strength will partially offset the recent fall in oil prices, while strong dollar will support free cash flows. So I'll get into the implications of all that, what we can do with all that cash, but then I'll turn it over to others.
Okay. Yeah. So speaking from a standpoint from the private sector and thinking about what Microsoft is doing right now around funding, we have a $1 billion climate innovation fund. And that fund is specifically used to target both nature-based and tech-based solutions. We're focused really on investing where capital is needed around climate solutions that not only meet the standards of starting new areas of innovation, but also what it means around climate equity and ensuring that developing economies and underserved communities also benefit from climate solutions. We're looking at really accelerating growth in areas of niche technologies, not just direct air capture, but other companies around building management solutions, looking at some of the green scale solutions for heating and cooling systems. And also we support not only directly funding projects and companies, but also where the technology capital is needed in some of these niche areas. I also work, like was mentioned, I sit on the board for Greentown Labs, and one of the things from private sector perspective is really focusing on how we're going to support the entrepreneurial landscape for climate technology. And this is really important not only from an equity standpoint, but also when we think about what's needed to solve the problem. The complex solutions come from that entrepreneurial landscape. And also being able to fund underserved communities and the technology that will most benefit them. So some of the work that I do at Microsoft is focused around that industry strategy, where I help to connect the dots between the digital enablement of sustainable transformation. So I work across hundreds of companies every year, helping them to not only build out their sustainability roadmap, but really redefining what it means when we start talking about the business of sustainability. And this incorporates not just ESG goals, CSR, corporate social responsibility, but how those dollars within organizations are being funneled for technology innovation. And, you know, not to be understated, and I'm going to talk about this a lot, but when we start thinking through the regulatory landscape and climate equity, what does that mean from an operational standpoint? When we start implementing these solutions, when we're going through the strategy of building the plans, designing the execution and implementation, what does that mean for the communities that we come from? And so that's one of the primary missions that Microsoft has. One of the things that they talk about is for Microsoft to do well, the world has to do well. And that is at the core of how we look at the impact that $1 billion in our Climate Innovation Fund lands, how we can drive scale, how we can drive innovation and niche technology solutions, and then how do we implement those solutions in an equitable way.
Travis, thank you very much. Appreciate it. I've had the pleasure of working on a number of interesting projects this summer, but perhaps the most interesting was looking together with a couple of our fantastic researchers here at the issue of whether or not we can come up with policies and commercial practices that allow us to pursue simultaneously both energy security goals and climate policies. I'd like to identify Meow Meow Rimmer, if she's here, and Teresa Hosel. I don't know if they're here or not, but they've done just yeoman's work and done a great job. We presented this opportunity, this paper in Milan a couple weeks ago. And one of the key takeaways, of course, we concluded that yes, there are a number of ways of doing this, and our focus really is cross-border. But some of the conclusions, I think, will ripple back here as well for domestic policies and financing. And there are a number of ways, of course. You could say demand-side management fits both of those. Energy investment, energy storage devices fits both of those goals, and so on. Not all of those are immediate, and some of the for example, investing in energy storage devices, we've been at it for quite a while, and we're going to be at it for quite a while, I think, in terms of working up on the curve. But the needs in places like Europe for energy security are quite acute as well as chronic. And so one of our key focal points was liquefied natural gas, and as being something that meets both of those two criteria. I suspect that's not a big shock to this audience, but I will say in northern Italy, to a largely European audience, I had a little bit of selling to do. I pointed out that natural gas has only half of the carbon of the CO2 that coal does, and is a third less than oil, to which the predictable response was, well, yes, but of course methane emissions are critical. I said, yes, of course. Before I get into methane emissions, I assume you asked the Russians that before you signed up for 50% of your gas from them. There was no response to that question. I then pointed out that, in fact, great work is being done on methane emissions in the United States of America, which they were not aware of. That work's being done by some of our largest companies, whether it's ExxonMobil or others, and many of our smaller independents. It's being done in the Permian Basin. It's being assisted by some wonderful NGOs, from EDF to some groups like MIQ and others. We're going to talk about, I think, some of that today. But in short, yes, LNG is a mechanism for pursuing both of these goals, particularly if you're looking at floating storage and regas vessels in Europe, the opportunity to employ these very quickly, right where they're needed. And then when you have a fleet of new offshore wind turbines, which the Europeans will say take 7 to 10 years to site, when you have a new fleet of those ready to go, you weigh anchor and you take your LNG charter elsewhere. So you're not locked in. But having laid that out as a possible, one of several possible solutions, I'll say I see 3 challenges to financing of these and other major cross-border energy projects going forward, and I hope that we have a chance to touch on them. The first of the three challenges is that almost exactly a year ago at Glasgow, COP26, the UK, US, EU, about 20 countries agreed to ban all public finance of fossil fuel investments outside of their own countries. So they applied a different standard to everybody else than to themselves. They had some very, very, very limited exceptions. I won't take your time with it at the moment. Happy to talk about those later if people want. This was before the invasion, of course. Since the invasion, there's been some wavering, some waffling. Some have said yes, maybe. Some have found some exceptions. But just last week, a major European public investment bank said no, they would not fund an LNG project in Africa. They didn't say anything about not funding one in Canada, interestingly. So that is an issue, whether public finance is going to be there to help with these projects. And that's important, not just for the size of the amount of money, but because they often wear the political risk that allows commercial banks to come in behind them. The second is ESG itself, not because investors don't want ESG, but because there's no common metric yet for what the E is. And there's a lot of work being done. A lot more needs to be done, but some commercial banks say they won't lend to fossil fuel projects, but do. Some say they will lend, but only to midstream, not to upstream, because they don't want the carbon on their books. They'll take the steel on their books, but not the commodity on their books. There are many different standards of what the E in ESG is, and many great groups are working on this, including some folks of ours at Rice. And so standardization, transparency, and accountability are a must in their own right, but also for financing. And third, EPC costs with inflation going at 8.5%, interest rates up 400 basis points in 1 year. These are driving some projects out of the debt market at the moment, out of the bond market. We had a very public announcement of a bond deal being canceled here about 10 days ago. And this has to be addressed just in terms of the financeability of projects as well. So hopefully we can touch on some of those.
Great. Mari?
All right, thank you for having me. So I represent the oil and gas banker.
You're the good guy.
Yeah, I know, I'm the fun one. So a little bit about BOK Financial. So our roots go back to 1910. We were founded as an oil and gas bank by producers in Oklahoma. And it was done that way just, again, to specifically address some of the unique challenges to lending to oil and gas producers. Fast forward to the 1990s, the bank was purchased by George Kaiser, who is an oil and gas man himself. And so when you look at the footprint that BOK has in energy, you can look at that the majority of our book is 16% of our portfolio is made up of oil and gas. Of that book, about 80% is upstream, 15% midstream, and about 5% energy services. So going back to Amy's original points, absolutely. Where we are in terms of structures and where our companies are, a lot healthier than they were 2 years ago. I think right before the pandemic, there was already a crisis sort of happening with a lot of our oil and gas companies. COVID sort of just pushed them over the edge. And sort of we now have come out of that a little bit cleaner slate, but what you have now are companies that are free cash flow positive. Most of them, their leverage is sub 1 time levered. Overall, bank structures are tighter, but you also have a much reduced world when it comes to banks and those lending to energy. You mentioned a little bit about, pressure that banks get to lend to fossil fuels in other countries. And so what we saw is an exit of a lot of foreign banks, but all they did is retrench at home, right? They sort of focused on their home production versus necessarily lending into the US market. So with a lot of banks exiting our space and some exiting, again, because of pressures with fossil fuels, but a lot of them took a lot of hits during the downturn. So most of them exited because they didn't want really to have to deal with or have to understand or build out more structure around handling the risk and the volatility that comes along with lending to oil and gas. So again, we have a tighter market when it comes to lending. We have tighter structures. We have a much smaller universe when it comes to energy lending. But I think what you'll find is we're sort of pivoting now into a different area, which is what happens now that you have so many energy companies that are free cash flow positive that are not necessarily utilizing debt today. Where do they go to, necessarily either expand their business or potentially for mergers? Where does that go in 2023 and sort of going forward? And I think that's a little bit of what we'll get into here shortly. So I'm excited to talk a little bit about that.
Great. Jeff?
Yeah, just to piggyback on Mari and Steve's comments, I think about, financing the energy transition, it takes some perspective of financing energy, just acknowledging kind of what, the base, energy consumption is today. And when you think about the classic energy world, so think about oil, gas, and coal, we're coming off, these businesses are very profitable today and have been kind of over the last year. We're coming off about a decade of very poor returns for investors, very poor returns realized by the business. So these, whether you're talking about a coal company or a natural gas-oriented company, they're kind of just getting their driver's license back and permission to make investments and permission to risk capital, because it's been such an atrocious environment for the investors in those businesses. There's a lot to be excited about in the emerging energy world. There's a lot of innovation. There's a lot of interesting technologies. There's a lot of good things going on. I think it takes a little bit of recognition as well that it's early days in terms of market development. Think about, there's a lot of exciting things going on in hydrogen, but the demand side is still emerging. There's the risk profile of both technologies and projects is still relatively elevated. And so while there's a lot of capital for low risk projects, for example, these are not low risk projects today. There's scaling challenges in the business. There's regulatory challenges. And so it just takes a little bit of acknowledgement that this is going to take time to mature. And so thinking about energy financing holistically, I think, is a more reasonable approach.
All right, so I'll ask folks in the audience, if you have questions as we go along, please go ahead and fill those cards out and get them passed up to the front. I'm sure you have much more interesting questions than I do, but I'll start off with Mari. So Mari, we heard Mark Finley in the prior panel say, basically because of the decline curve and depletable nature of oil and gas resources we're all familiar with, we need to invest more in hydrocarbon production to meet existing and near-term demand, even while we increase investment in renewable and storage growth. So put another way, the need for oil and gas isn't going away anytime soon. I think the last panel made that clear. But it doesn't seem like the current financial markets necessarily see that demand as the most solid investment of capital, particularly with what Jeff has been saying recently. And maybe price is a riskier asset class given some of the financing spreads in the last decade. Can you talk to us a little more about what you're seeing in the market, particularly to what extent debt capacity is out there for upstream?
Sure. So if you look at, where we are today, again, I touched on it a little bit. Structures are absolutely tighter. Capital is tighter. It used to be, 10 years ago, you could easily pull together a syndicate of banks and raise $1 billion, $2 billion for a company. Now we kind of see that senior secured, band is around $1 billion, maybe 850 million, somewhere around there. When, we look at it from a bank perspective, a lot of the things that we're looking for, and I'll first talk a little bit about kind of upstream, and then I'll kind of pivot a little bit into ESG, is a project viable, right? When you are looking for, when I started my career, the traditional energy loan was a reducing revolver. So I would loan you money, and every month you would pay me down, and we would get to a point where, 6 months into the future, we would reevaluate you, and I would decide, do I raise your borrowing base again, or do we drop it? Flash forward to where we are to, maybe 5 years ago, it was really a big credit card. And what we were allowing companies to do is go out, develop, acquire, make distributions, but really the payoff for a bank was at the sale of a company. And that's really how I got repaid. where you are today, to a little bit of Jeff's point, is, people being in the penalty box for not being able to, one, return capital to their investors, but also not being able to repay their banks. So again, tighter structures today. Where are we going forward? Many of my clients right now, it's an interesting time because they are so free cash flow positive. Our debt is getting repaid. I would tell you, going over the last couple of years, most fundings were about 50 to 60% funded utilization under the lines. Now, it's probably dropping, and most of my clients, I will say, will be 10% funded, being easily able to pay off the facility if they wanted to. Most of them have an untapped line, again, in case there are opportunities to be able to acquire someone else. But realizing that potentially that public market may not be there for acquisitions, that potentially there is a finite amount that can be raised with debt. The line utilization is dropping more and more, again, to be able to have that flexibility going into 2023, 2024, where potentially they might be able to acquire an asset, a company, or potentially look at, more development. With regards to sort of ESG, I don't think any bank would tell you that's a no or we won't fund those. I think for most people, it is like a pie, right? Today, fossil fuels is a bigger piece of that pie, but I think with innovation, with time, that flexes, and you have, the other pieces sort of become bigger pieces of that pie. Does it happen today? No. But from a banker's perspective, what we want to understand is that project feasible? How do we get repaid? Because again, I'm a senior secured lender, and my responsibilities are to my depositors, my shareholders, my investors, to my employee base. So again, finding ways to finance really comes down to, currently, is how do we lend to the fringes? We lend to the manufacturer that creates the blades, or the manufacturer that, necessarily provides a certain part for something. That's really where you will see a lot of the lending going on. At least today, it is finding those unique lenders for those projects that maybe aren't profitable at the moment.
So then if the traditional commercial bank and large bulge bracket balance sheet banks aren't funding some of this development risk, who's funding it? Who's coming in and stepping in for these things? Equity, right?
It's equity and cash flow of the business.
Okay.
Yeah.
Okay.
I think what I've seen is some of the equity providers that support many of my oil and gas producers, they also have offshoots that specifically focus on these projects, right? They're into R&D. They're looking to understand the technology behind a lot of these different projects that are going on. They may not be feasible, but they see that there is a future in that, and to not invest in it today, or at least start investing in it, would kind of put them behind. So I do think some of that just comes from, again, equity and investors and potentially, financial institutions that feel pressure to lean into renewables and ESG.
And so you mentioned ESG. When you were talking a little earlier about the project evaluation, you're thinking feasibility, you're thinking about, are you getting paid back? To what extent is ESG really playing into a lot of these lender decisions, specifically when we're talking about upstream?
So I will tell you, every single deal that we look at today, and the first question that we get from a lot of bankers is, talk to us about your ESG, project profile. How does your company look at this? How do you address it? That's still important, because they obviously have to go back to their credit committees and get that approved, and there are questions around that for sure. I think it can change and evolve depending on what institution you're looking at. Again, the larger the institution, definitely you'll get a lot more questions around ESG. Many of our clients are absolutely,
leaning into that. They want to be on the cutting edge. They want to understand it a lot more. They don't feel like it's an either or, right? It's not, you're either an oil and gas producer or you're environmentally, it's not an either or. It's coupled together.
I would just add that it's not just for lenders, but almost always now in M&A, when we're looking, there's a lot of people who are either, divesting assets or looking for assets, good deals right now. And it's just become required that in all of our due diligence and modeling work, that the ESG aspects of those assets, especially whether they're their methane emission and what's been done to digitalize them, the efficiency of the sensors, et cetera, the degree of remediation. So that's new, that we're being asked to actually quantify the remediation needed to be lower emission producing assets for consideration for deals.
And do you think that's affecting pricing at all when you're having to
absolutely.
quantify that?
Yeah.
It's incredible what's being done in that regard. I mean, just really in the last 12 to 18 months, both by the groups that are establishing standards and by the industry themselves. So if we look at methane emissions, just a few years ago, the 2% figure was being bandied around as maybe that's sort of what's going on in the industry. Now you take a group like MIQ, not for profit. They objectively measure with meters, with trucks, with planes, occasionally with satellites. They have a scoring system, A through F, based upon 3 factors. What is your measured emissions rate? How frequently do you check? And what is your set of corporate policies? And if you have that 2% figure, and if you remeasure every year, and if you meet the minimum standards for corporate policies, you get an F. You have to be 40 times better on emissions now to get an A. It matters. ExxonMobil and others have signed up for this, and I'm sure it matters in the deals. I'm sure it's good, something you're going to see.
So, Steve, let me ask you, we've been talking about upstream, but what about in these LNG projects, the mega projects, right? Like financeability of individual wells, that's one thing. Financeability of a train, like that's a totally different beast. There are a lot of other factors that go into figuring out, is this a bankable project? Can you talk a little bit about, with all of the developments that we've had this year, particularly over in Europe, are all of a sudden new LNG projects sprouting up like daisies, or is that not really the case yet?
Well, it certainly is the case here in the U.S. that we have potential projects sprouting up like daisies. More than half of the projects under construction that will come to fruition before 2026 are in the United States. And then following that, Qatar will, of course, bring on a big slug. But you have to go out quite some distance to find a lot of LNG being added anywhere in the world that's sizable, that's under construction, other than the U.S. and Qatar. Yes, I know there are bits in Mozambique and elsewhere, but overall, that's really the case. You fundamentally have, the challenge of you got to raise billions of dollars for these deals, and so I'm hiving off the upstream for a moment, and let's assume this is a tolling plant, right? In other words, the customer is going to go get their own gas. The customer is going to own the gas all the way through the plant. They're going to own the LNG. They're going to have risk of loss. This is just steel in the ground. So now you've got to finance anywhere from $10 to $20 billion, depending on the size of the plant. It's a competitive market out there for debt. It's a competitive market for equity, and the biggest challenges I mentioned. 400 basis point increase, 8.5% inflation in EPC costs. These are some of the biggest challenges. There's demand for gas out there in the world, so it's doable. It's doable. Now, if you're going to reach upstream, for integrated project, then you get into the question of, will banks want to take the commodity risk and the carbon onto their carbon balance sheet?
We got a question for the audience. I'll ask while we're talking about oil and gas. Are folks seeing bank regulators putting pressure on these banks for having so much oil and gas exposure, or is that not as much in the calculus at this point?
I think you get questions, but there's no real pressure to say you have to exit X percentage or you have to be under a certain percentage. I think that pressure comes from investors in that particular bank, but not regulators per se don't put pressure on you to change a percentage. Now, again, they ask a lot of questions for sure, but.
Okay. So why don't we turn to kind of renewable energy storage and similar projects. So Amy, I'll ask you, so we know heavy industry and others are motivated to decarbonize right now, particularly with the pressure they're feeling from institutional investors, ESG activists, lenders, customers, employees, and regulators, and now tax incentives. So in order to meet some of the future energy demands of these companies, it looks like we're going to need many massive multi-billion-dollar projects, including but beyond LNG, that are being proposed now or that are going to need to come online or be proposed in the next few years. So some of these are focused on the renewable technologies, wind, solar, and others are in transition fuels. Where are you thinking that the dollars are going to come for all of these projects?
Well, I already mentioned the 1.4 trillion.
Yeah.
And actually, that gives, there's enough in there for companies to take care of their stakeholders and their dividends, and there is surplus. But you've got, basically 4 types of companies. You've got your hydrocarbon stalwarts who are saying, this is the moment for us to continue to make digitalization improvements, improve the efficiency and effectiveness of our operations, stay lean and mean, acquire good opportunity assets. So they're not moving along that spectrum. And then you've got you've got your green energy pioneers who are saying this is the moment to transform our business. You see 2 of the super majors based in Europe really making moves in that direction to say we're going to be less dependent on fossil fuels. They haven't stopped drilling and exploring though.
Of course not.
But nonetheless, there's huge investments being made in low carbon technologies such as CCUS, hydrogen, renewables, and so you're going to see companies all along that spectrum doing both. But two things that I think will make a big difference in these huge projects really getting underway are one, regulatory help. Okay. There needs to be real serious consideration based on facts around permitting and regulatory barriers and pressures around financing. And it's going to take, these projects are multi-billion-dollar projects, the CCUS and hydrogen, are low-carbon hubs, because there's multiple kinds. And it's going to take collaboration that we really haven't seen a lot in this industry before, in terms of public-private, where you have to include not just local, state, county, federal bodies to help get these projects underway. There's a lot of wanting to do these projects, but not a lot of shovels in the ground, as I think Steve was referring to. So you're going to need real regulatory help and collaboration, and including permitting help. And the other thing is there's a big innovation gap. Don and I have been discussing this. There's still an innovation gap that I'm hoping that some of these billions of dollars will, that you've got companies who have been, frankly, transforming in this industry for decades. Yeah. This is not a new frontier. Really, actually, it's an exciting frontier that our industry is in. That there's lots of opportunity, but there is an innovation gap. We need more R&D, especially around, continued digitalization, going beyond just the obvious, the huge swathes of data that are now available that companies still don't have great transparency into. Their supply chains aren't transparent enough to get the data they need to do scope 1 and 2, let alone scope 3 without standardization. And frankly, you need, I'm excited that I think we're going to see across all the spectrum, including with batteries and special materials, huge leaps underway, a bit more needed around quantum computing and chemistry and advanced materials.
Don, can you talk to us a little bit about some of this innovation that's needed and what role Microsoft maybe playing in this and others?
Yeah, no, absolutely. And Amy is spot on in highlighting the gap between innovation and around some of the regulatory policies and standards that are required to be able to implement some of this new technology. So on the space of where we are today, the existing operations, there's, especially when we're talking about in the heavy industrial sector, there's a real lack of digital maturity in this sector. And what that means is that we don't have the data to be able to prove transparency. Right, and when you start talking about supply chains, there's a major issue around siloed data, and still having a lot of that kind of data being collected from analog. So when you start trying to pull together what that means from de-risking the decision-making process to understanding what the emissions landscape looks like around a value chain, you really do have these major gaps. So that's when we start looking at operations from an existing standpoint. And then from an innovation standpoint, there's also a huge gap, again, around regulatory standpoint, when we look at being able to put new holes in the ground for a different purpose. Right now, those things are, most of these projects are regulated by different existing acts, right? So like the Clean Air Act or just different acts that kind of currently govern how we're able to put things in the ground. And one of the things that I'm personally working on is how do we digitally model the molecule from acquisition, transportation, and subsurface storage, right? And so that we can actually prove that molecule, if we're talking about carbon dioxide, how do we prove that stays underground for a geologically significant period of time? What do those models look like? What does the regulatory ecosystem look like for us to prove that? Right now, organizations are having to build it on their own and then prove that science back to the government. I used to work in water resources for the Department of Interior, and that was one of the things that we used to research quite a bit, is how do we model that molecule of water when we sequester it from a waste management standpoint. We used to sequester wastewater. And how do we prove that it doesn't come back up, it doesn't infiltrate the drinking water zone, and it's the same thing when we start talking about sequestering carbon, right? And so that's really important from a digital standpoint, because that's what most people are looking at for how do we prove it, how do we have that transparency and accountability. And then also when we're talking about just the landscape of bringing new innovation, new technologies, because as we've been talking about across all of the panels, there's an urgency of now, right? And there's a difference between when we have, we were talking about this earlier, when we have governments, when you look at the different kind of geopolitical landscape, governments that are run by engineers versus governments that are run by lawyers, right? So there's a difference between how innovation.
No, that's great. I get it.
Taking an ugly turn.
I don't mean any offense at all, but there's a difference between the speed that innovation can take effect, right? And that's one of the things that I personally see. I see that here in the United States. Like I mentioned, the NEPA Clean Air Act, the Endangered Species Act, the Underground Injection Control Act. That specifically, when you look at the language around it, it's not necessarily physics-driven or physics model-driven. It's around the legal language of how this works, right? So the way that these acts are put together, that's all that organizations are using to navigate this space, and it's not supporting the science and the engineering required to implement the new technologies, right? So at Microsoft, we span the spectrum of all of these issues. We look at it from the digital maturity required around existing operations. We look at how do we advocate for policies that spur innovation. We also look at it from How do we influence, how do we influence kind of our sphere of connectivity, our customers, our partners, our supply chain? How do we change the way we work to influence the world around us? So that's a big part of Microsoft's mission. And then, again, at the heart of how we address that is not only our employees, but also the people that are impacted by our sphere of influence, right? And it's really important for us to, as we're creating these strategies, reimagining our energy transition, because that's what we're doing. We're reimagining these economic structures to support this energy transition. We have to include the S in the ESG. And make sure that we're creating solutions that are good for the least among us, because that is going to be the criteria for success.
I have a question.
Oh, sure.
Just to ask, is that transparency, is that what brings back investors and money back into sort of our sector, is being able to understand, what really is going on from the molecule all the way, to how do we finance it? Is that how you bring back investors?
Yeah, I think it's important. I think also just the business earning good returns is important for reattracting capital. So I think they're both important.
Yeah, I'll just chime in that I think it depends on whose money you want. There are some people that are really focused on return. What is my total shareholder return, right? There are other people that are banks that are just like, I just want to get my money back. I've got to pay people back. There are even pension funds that say, I'm more focused on meeting these retirement demands than I am on ESG concerns. There are other funds that marketed themselves as being ESG focused, and if they do not meet those ESG demands, the SEC and investors will hold them to task. So it's really, who do you want to get that money from? Jeff, let me ask you, so we've been talking about innovation, some of the developments, and again, the future of energy, right? How is that actually getting funded? I know the Veriton guys, you guys have talked a lot about this. You're also putting money to work here. What does it look like at the different spaces for innovation and invention?
Yeah, I'll end up oversimplifying, but I'd say, one bucket of money is existing industry. So whether that's the large existing energy companies, ranging from, upstream integrated to power. I think bucket two would be kind of, I'd call them like project developers. These are probably the bucket of money that is, going to be most able to take advantage of, IRA, of DOE loan program, et cetera, where it's put a little bit of money in, lever it up, take full advantage of, of tax benefits, and make a decent return. It's hard to scale that. There may be buyers of it in the existing industry world as those projects come about. And I'd say some of the innovation, if you just oversimplify it and say software and hardware, so low capital intensity, high capital intensity, much easier to attract capital for a low capital intensity software business, much harder to attract capital for hardware and something that may be capital intensive. And it's you think about a software business, with $10 to $20 million, you can probably figure out if it's going to work. In a hardware, in a new technology business, you may be $100 million in and not have an idea if it really works or not. And so just structurally, we're over-incenting software and probably not incenting enough new innovation in new technology.
And so is the funding gap there, well, is the solution going to be the government, like subsidies? We've heard a lot of talk today about the IRA and the changes that's made in order to incentivize a lot of the technological and project development.
I think government can be helpful. I don't think government really ultimately tips it over and really drives innovation. I think there has to be, you have to be playing for a prize, and that's really profit motivation at the end of the day. I think it can be helpful, and I think it is helpful. Don't want to be dismissive at all of some of the subsidies that are being put in place, and I think they can help. I think it's not so much a gap. I think it's really hard to, I think it was said in the earlier panel, if you want a quote transition today, there's not enough money in the world. If you want it 100 years from now, there's plenty of money. Where on that continuum are we, I think determines, how much of a funding gap there is or not. And it's just really hard for, there's lots of smart people, and it's hard to coalesce around a view in that, and I think that makes it even challenging to talk about it. If we're talking about, the world changing tomorrow, there's just not enough money in the world, but we will evolve. And so I think some of it is patience for the regulatory regime. You can't push a string, from attracting capital if there's, for example, in CCUS, not determining where that is your CO2 molecule taking up someone else's pore space. Until we figure all that out, how do you attract capital for a project that, may or may not happen?
Carbon tax.
Yes. Yes.
Yeah. So thinking about that timeline and how we're trying to get from now, T0 to this future, which, we're not really sure whether that's, well, I guess it depends on who you ask. They're going to say, well, we need to be there today or yesterday if we're going to meet certain climate goals. Others are saying 2050. Others are saying, look, even that, it's just not realistic. We're not going to get there on the current investment horizon. I'd be curious to know, kind of to Steve's question earlier, with these ESG goals that are being pushed by a variety of stakeholders, how are those stakeholders' ESG focus actually affecting what you're doing? You mentioned earlier in the acquisition space.
Sure. Well, there's coming ESG reporting requirements, which are going to, it's a whole another level of compliance around, and actually I think Steve mentioned before, several people have mentioned, we need some sort of standardization, some standard measuring, standard reporting that puts everybody on an equal page, because right now people can claim whatever, and it's not necessarily valid or credible or frankly, able to validate. So it's certainly going to impact our profession, that we'll be asked to, do some sort of limited assurance on whatever companies are disclosing. I think there's a delay right now, which for good reason. They got over 16,000 comments on their proposed draft, which would tell you that means it wasn't ready for prime time.
Right.
With legitimate questions around, the things that were being asked for Scope 3 emissions just aren't there today yet. So I think coming standardization that put people on fair reporting basis will be healthy for everybody and have more transparency.
I'm kind of seeing a match made in heaven between Deloitte and Microsoft right here on trying to figure out what we're going to measure, standardizing that, kind of like GAP, the new GAP.
Let the lawyers in.
Well, the lawyers are going to have to look at it.
Or the engineers, right?
Yeah.
Exactly.
Okay. So I think that we are just about out of time. I appreciate all the comments that we got. I apologize if we weren't able to get to all of those. But please have a round of applause for our wonderful guests.
So that actually brings us to a close for today. I want to thank all of our speakers on this panel. I actually told Joe, I think the most intriguing thing I heard was the discussion between Don and Amy about the gap, right? Just thinking about the technology gap and what it's going to take to overcome that. So a lot of food for thought. Hopefully it sort of resonated with all of you in the same way. It's the only way we can come to solutions is by having hard conversations and identifying problems. But we will convene again tomorrow morning at 8:30. We're going to kick things off with Bobby Tudor and then launch right into a couple of panel discussions before closing about the same time tomorrow on the heels of I'm really anticipating this, what should be a great conversation between Ambassador Satterfield and Secretary Baker. So see everybody tomorrow.
Travis, got it right on the edge. That's one way to end it.
Great job.
Hey, thanks.